Dealing with item number 10, which is the examination of the behaviour and culture of the Irish retail banks report and quarterly engagement. Governor Lane, I want to welcome you and your colleagues to the meeting. We're going to deal with the culture report on the banks first. I understand that you will have an opening statement in that regard, and then we may break for 10 minutes and then deal with the other general issues. That's the format for the meeting. So I wish to advise the witnesses that by virtue of section 17(2)(I) of the Defamation Act 2009, witnesses are protected by absolute privilege in respect of their evidence to this committee. If you are directed by the committee to cease giving evidence in relation to a particular matter and you continue to do so, you are entitled thereafter only to a qualified privilege in respect of your evidence. You are directed only evidence connected with the subject matter of these proceedings is to be given, and you are asked to respect the parliamentary practice to the effect that where possible you should not criticise nor make charges against any person, persons or entity by name or in such a way as to make him or it identifiable. Members are reminded of the long-standing parliamentary practice to the effect that members should not comment on, criticise or make charges against a person outside the House or an official, either by name or in such a way as to make them identifiable. I want to invite you now, Mr. Lane, to give your opening statement, please. Thank you.
Thank you. Good morning. Chairman, committee members, I welcome the opportunity to meet with you this morning for our regular engagement. I'm joined today by Derval Rowland, the Director General for Financial Conduct, and Ed Sibley, Deputy Governor for Prudential Regulation. So, as indicated, I will divide my introductory statement into two parts. In Part A, I'll provide an update on the tracker mortgage examination and the outcome of our recent culture report. And then, when we get to the second part of the meeting, I'll turn to the broad macro-financial outlook and outline the main issues and risks we see on the horizon, including non-performing loans and Brexit. So in Part A, I want to focus on the culture report. Now, where is this coming from? It's coming from our conviction that consumers are best protected if firms not only comply with our regulatory requirements, but also invest in organisational cultures that reward consumer-focused behaviour and penalise harmful behaviour that seeks to skirt around the duty to treat customers fairly. The wider context is provided by the fact that in the last decade, we've seen many financial misconduct scandals around the world. At home, the mistreatment by banks of so many tracker mortgage customers has shown that financial misconduct is a substantial risk to households and firms that rely on the domestic system for the provision of financial services. Our tracker mortgage examination, the largest, most complex and significant customer protection review we have undertaken to date, was undertaken to ensure that lenders identified those customers harmed by this mistreatment and paid out appropriate redress and compensation. In terms of the latest data, by the end of August, lenders had identified around 38,400 customers, if we include those which had been resolved also before the examination was launched, and have paid out $580 million in redress and compensation. So in terms of this current state of play, that means 93% of affected customer accounts of those already identified and verified had received offers of redress and compensation by the end of August. 4 of the 5 main lenders are close to completion, and we are exerting significant pressure on the remaining lender to finish its process. In addition, our bank-by-bank supervisory review of the conduct of the examination is also significantly advanced, but will not conclude until all is done. We will continue to challenge them where necessary in order to confirm that all groups of affected customers have been identified and included for redress and compensation. On a separate track, enforcement investigations in respect of 6 lenders are in train. Now, of course, what I've focused on the last couple of minutes are the macro numbers, the thousands of those involved. But we all fully acknowledge that these statistics don't give the full picture. That when we think about the individuals who've been harmed, especially those who might have lost a home or a property, we fully recognise that this has had a devastating effect on individuals, which the money numbers cannot capture. So what this examination has exposed is maybe yet again further evidence of a lack of consumer-centred culture in the lenders. So even in how the examination itself was conducted, let alone the original tracker problems, we found some banks adopted a narrow legalistic approach while offering initial compensation proposals that fell well short of our guided expectations. So we think that the examination itself raised enough questions about the current and not just historic culture in the banks. And this is why we were very pleased to work on the culture report that was requested by the Minister and that we published in July. Now you might ask, well, why are regulators focusing on this concept of culture? And by the way, the culture report is just the latest step. Our supervisory approach in recent years has been strengthened to focus on conduct and cultural issues. And if you like, this is an evolution that in the wake of the crisis, the immediate focus was on strengthening solvency and stability of the system and enhancing protection frameworks for consumers. So at that level, a lot was done. And let me emphasise that we now know that banks and other financial institutions have more and better quality capital, have more sustainable funding structures, are better governed, and are more strongly equipped to deal with any difficulties in the future. In addition, we have the macroprudential measures, and for example, through stress testing, we do focus on their ability to withstand adverse shocks. And in addition, given all of the misconduct we've seen, there's much more extensive conduct regulation in order to protect consumers and investors. That said, we do think all of these rules and regulations should be reinforced by an additional focus on the organisational cultures of these firms. The boards and senior managers of these firms are responsible for ensuring that organisational cultures are focused on enhancing consumer protection and ensuring that risks are well understood and managed. Accordingly, how best to achieve this has become an increasing area of focus for regulators. So in terms of our supervisory approach, the importance of risk management, not just focusing on risks that materialise, but risk management in advance, means that we've introduced a new consumer protection risk assessment model, which is designed to help supervisors assess how risks to consumers are being identified and managed within firms. We think another important dimension of this is to improve the levels of diversity at senior levels in these firms. We think that diversity can improve decision-making, reduce the risk of groupthink, improve risk management, and in so doing ensure that organisations give sufficient priority to the experience and treatment of their customers. In terms of the report's findings, what we have looked at underlines the fact that organisational culture builds on a shared purpose, so that the bank needs this shared vision and standards such as professionalism, honesty, integrity and accountability to deliver fair outcomes for consumers. And this is what we expect in the firms we regulate. So the report was built on 5 focus studies on the 5 main retail banks. And what we have found is that they're not there yet in building a truly consumer-focused culture. How we went about this work was in partnership with the Dutch Central Bank, which is a recognised leader in the assessment of bank cultures. The review team was diverse in composition, including conduct and prudential supervisors, experts in risk governance, and organisational psychologists. The reviews included both on-site and off-site assessments in order to ensure the necessary breadth and depth of the analysis. So it included 1,400 hours of desk-based review of materials, more than 500 surveys and 75 interviews, in addition to observing meetings and assessing decisions in each bank. The focus was on the executive committee of the bank, since this group is responsible for driving the behaviour and culture in an organisation under the direction of the board. Now, what do we mean by an effective consumer-focused organisational culture? Well, it's one in which consumer needs are adequately identified, discussed and taken into account. Now, we do find that all of these banks have taken some steps to reinforce the consideration of the consumer interest in strategy, decision-making and procedures. But clearly, some are more advanced than others. We also looked at behavioural patterns in leadership, how strategic decisions are made, and the general outlook of these firms, which could put at risk the successful transition to consumer-focused culture. And we do think, as indicated, that these cultures remain underdeveloped, and a barrier to successful implementation is some obstructive patterns of behaviour. So, for example, we saw in some cases executives continuing to operate in a firefighting mode, which may have been suitable in the crisis, but as we come to more normal conditions, is maybe no longer appropriate. We saw too much focus on dealing with the short term and with legacy issues, with insufficient attention paid to consumer interests. In some cases, we saw some reversion to command and control in leadership styles, and we do assess that the banks have much more work to do to ensure that their organisations are sufficiently diverse and inclusive, especially at the senior level, which, as I indicated, would be helpful in preventing groupthink, guarding against complacency and overconfidence, and promoting internal challenge. Now, is this report going to sit on the shelf, or what are we going to do with it? And there are already action points. So each bank, the boards of each bank are required to make a number of steps in the bank-specific requirements to them to investigate and assess potential drivers of unhelpful behaviours, identify what the Executive Committee needs to do to fix these problems, and create an action plan to address the concerns identified and mitigate the associated risks. We expect the banks to be proactive in promoting an effective risk culture and to fully embed conduct risk frameworks. In addition, in terms of how we supervise them, there's going to be further enhancements of our supervisory approach, including more intrusive, targeted supervision of the conduct of these firms in a risk-based way which identifies the areas of greatest potential harm to consumers. Now, we think this is also in the long-term interest of the banks. So, if you like, that there's incentives for the banks to embrace this agenda also, given all that we've seen in terms of the costs of dealing with misconduct after the fact. And we think it's important in this whole procedure that banks understand the difference between looking for the trust of people and actually establishing trustworthiness in their culture. It must be earned, in other words, in order for trust to be restored in their organisations by building a track record of consumer-focused behaviour. Now, that's the kind of guidance we give, but of course, this is essentially an executive responsibility in each bank to build that culture. So it's not the case that this one single culture can deliver. This is part of what it means to be a skilled manager of a bank, is to build the culture that makes sense for that bank. But we do require it to be have that consumer orientation to make sure that these firms will deliver fair outcomes for consumers, while maintaining financial resilience, while maintaining appropriate prudential standards. Another action point from the Culture Report is that it reinforces our advocacy of a new individual accountability framework to apply not just to banks, by the way, but to other regulated financial services providers. This would go beyond the current requirement for staff to be fit and proper. It would set conduct standards for staff and would ensure clearer lines of accountability within firms. So the goal of these proposals is to act as a structured driver for positive behaviours and to recognise individual responsibility. Many regulated firms and their leaders behave ethically and honestly and do seek to drive effective cultures. However, in order to guard against scenarios where that is not the case, these reforms will constrain the ability of senior executives to escape accountability for wrongdoing. These reforms, of course, are for the Oireachtas to consider and to approve, if you agree, and we do welcome any questions you may have on our recommendations. So in terms of the Part A review of the Culture Report and the tracker examination, let me stop there, and as I say, we can later on we can turn to Part B.
Sorry, Brian, just in your opening statement, there's no mention of sanctions against banks should they continue to ignore the drive for a better culture and focus. There's nothing in here. And at the end of it, just before we get into the discussion, in the last paragraph you say that it's now up to the Oireachtas for consideration and approval.
Of this extra step. This issue about the individual accountability framework is not part of the current regulations. So the UK introduced something similar about 2 or 3 years ago. So the issue about how do you hold senior executives to account, we think this is an extra step. But let me ask Derval to elaborate on this.
So can it's just for the to benefit from the discussion, and I know that Deputy Doherty has, I think, a bill on this. But are you saying that arising from this report, that what's required next is legislation, and you haven't recommended any sanctions in your report for banks that just ignore you? So if you just elaborate on that for the members.
Could I separate out those 2 points? Yeah. The Central Bank of Ireland already has enforcement powers where, if breach of rules are proved, sanctions can be applied to both firms and individuals. They are in place, they remain in place. The Central Bank, and they are used. More than 122 enforcement cases have been concluded to date, with €61 million of fines, and more than 12 individuals have been disqualified. The fitness and probity regime challenges the competence, capability and integrity of persons who are entering into senior roles and who are in place, and people have been disqualified there too, and we find more and more as we challenge, we find a lot of senior people withdraw rather than face the challenge of the Central Bank. And actually more than 50 cases of people withdrawing are there to date. So the enforcement powers, and we've been to the High Court and the Court of Appeal to vindicate our right to use them, are in place, are working. We have in this new legislative proposal, which will require the Oireachtas to approve and adopt to bring that legislation into place, some streamlining of the enforcement powers to make one uniformed process, some amendment to the current process which would break the link between participation of an individual's conduct and that of a firm. We think it would strengthen the ability in the future to take enforcement cases, and also then, in respect of the individual accountability proposals, we are making a proposal in a comprehensive way that mirrors the leading edge of approaches in other countries for a set of standards and an individual accountability regime which would require legislative action on the part of the Oireachtas to bring that into force. And it is that as one of the parts in the report that we are making a proposal, but it is separate to the culture report, which will require action from the firms to improve their own culture. But we see this as a complement to strengthening the approach that we're adopting.
Okay, thanks. Deputy McGrath.
Thanks, Chair. I'd like to welcome the Governor and his colleagues. Chair, the Governor dealt with the tracker issue in part 1 of his statement, so I have one question on that, if that's okay with you. Governor, you just put a figure of 38,400 impacted customers on the record there, which I think includes 7,100 pre-examination. Right. You say 7% remain without an offer of redress and compensation. So is that 7% of the 38,400, or of that minus the 7,000? Okay. So I'm just trying to clarify what is the number of customers that have yet to receive an offer of redress.
We can elaborate on the exact numbers.
Okay. So the current number of customers who are affected by the tracker mortgage examination is 31,300. Of course, there were 7,100 customers who received redress before the examination, and that's where the aggregate number of 38,400 comes from. The information that I'm giving you is that 28,100 of the 31,300 customers have been are in receipt of compensation and redress to date. That number, however, I just want to be clear, is subject to the high-level number is subject to change because it hasn't entirely been verified by the banks. what that means is, as they go through their verification process, they find there's duplication of accounts, etc., so that number can slightly change. And because we require them to be absolutely thorough in the final analysis, that, it has been our experience, can vary as people are checked. But in the round, the answer to your question is that there remain about 3,000 customers who have yet to receive payment in the tracker mortgage examination who have been identified. I think it's important to tell you that about 99% of the customers who were identified as at the end of last year have received their payments. Those who have not, it is because they can't be found or because the banks are engaged in complex discussions with them, and where the money in respect of people who can't be found, it's ring-fenced in an account, so it will be there for them. Also, in the main, customers who are identified and verified before March of this year also have received their redress and compensation payments. And we're in close scrutiny and monitoring of the payments that are being made by each of the lenders on a month-by-month basis and challenging them to get on with it. It is our expectation that in the main most customers will have received their payments by the end of this year. There may be some few that go into early quarter 1 of next year, but we continue to challenge that timeline. You've seen from the Governor's opening statement that 4 out of the 5 lenders are making reasonable progress with respect to concluding this matter, and one is somewhat behind the others, but we are putting significant scrutiny on them to keep up with the timelines to the maximum extent that they are capable of doing. But it's important to tell you as well that our own independent verification of these numbers continues, because it's incumbent on us to make sure that the decisions that have been made about including and excluding customers is adequately and thoroughly tested through on-site and off-site supervision as well as data analytics, and we are doing that before we close out on and give them the green light to say that that's done.
But of the 3,000 customers who have yet to receive redress and compensation, the banks know who they are. They have their identity. These are identified accounts and customers who have been impacted.
That's right. About 2,000 of those are verified now. There's 1,000 not verified that's going through the process, and all of those are timelined, and the identity of those customers is established by the banks and their timeline for them to get on with the payment. Each institution is being challenged and scrutinised closely by us to get on with that, and we do expect most of those customers to be paid in the coming months. And month by month, you'll see that progress is being made. I appreciate this shouldn't have taken this long in the first place, but most of these customers that we're talking about now have surfaced in the examination this year in more recent times.
Yeah, well, they may have surfaced. They were always there. They just weren't identified. I mean, I would just make the point to you, it was in December 2015, the Central Bank wrote to the lenders setting out the framework of the examination. So we'll be 3 years on from that in 2 months' time, and we still have a situation where 10% of those affected, identified as being affected, have yet to receive their money back.
Yes, and when we were here a year ago, we did say that there's been this delay, and this goes back to the Culture Report, where the delay, by and large, was foot-dragging by some banks. And then towards the end of last year, as we know, the banks more fully embraced their responsibilities in this report. But as Dermot indicated, essentially what's happened is those who were accepted at the end of last year have, by and large, been paid, except for some technical issues. But what's happened is that as more came into the scope of this, as the banks accepted that more needed to be included in the spring of this year, these are the remaining ones to be paid out. So, if you like, it does, I think, go back to the fact that we never wanted to put an absolute deadline on this, because for fear of leaving someone behind. And through this mechanism, you know, it's the fact that the numbers have grown is partly because we didn't close out the review at any point.
Sure.
But ultimately, these all absolutely should have been accepted by the banks from word go. No doubt about that. Yeah.
But why can't you put a deadline on restitution for those who have been identified?
Well,
Okay,
I mean, there are timelines here, and the only physical limitation on this is the systems in some of these banks, which basically it's an unfortunate technical reality. Is it that it does put a barrier to instant completion?
I can only repeat that we have every single bank under close scrutiny, close reporting timelines, and we have regular engagements with them to challenge the limitations that they say they have in identification and redress to customers. It's our single biggest conduct priority is to effectively get redress and compensation delivered from the banks to their customers, and we are doing all within our power to challenge them to deal with that. It's our aim to issue a final report on Tracker at the close of this year, and it is the team and I have been entirely focused on making sure that the banks move at pace and that we bring sufficient robust challenge to them.
Just moving on, Chair, just on the individual accountability framework that you speak about in the Behaviour and Culture report, I think from the point of view of the public, they believe that there has to be a consequence for poor behaviour. And so you're talking about the need for additional powers under legislation, so that's a matter for the Oireachtas. But specifically, what do you have in mind in terms of extra powers that you require, that you want from the Oireachtas to strengthen the individual accountability framework which already exists?
It's a fair enough question, but let me emphasize, and again, as you think about this going into the future, the good news here is we have a concrete example from next door, because the UK brought us in 2 or 3 years ago, and it was kind of the questions about, is this necessary, is this a good idea, what consequence does it have? We think we can see concrete changes now in how UK firms behave and how the executives of these firms accept this elevated degree of responsibility. But let me turn to Derval just because, again, this is part of our submission also to the Law Reform Commission earlier this year.
So the proposal that we're making about the Senior Executive Accountability Framework has its origins in us looking at the leading edge practices in other jurisdictions, and we made a submission to the Law Reform Commission last year encouraging this course of action. If we take a step back, looking at misconduct in financial services, a key driver for misconduct delivering poor outcomes for consumers can be said to be a lack of accountability at senior levels in firms. And a heightened focus on accountability and responsibility strengthens the outcomes for consumers and, of course, is as it should be in properly run firms. The proposal that we're making in this regard has a number of elements that all complement each other. If I start with what we view as the first element of that proposal, it is a very basic set of universal conduct standards that will apply to everybody in all financial services firms. These, you may say, are no more than one would expect of a right-minded individual in a well-run firm, but I think that these principles are very important, that everybody who works in financial services, no matter what role you have, from the top to the bottom, will be required to act with honesty, ethically and integrity, due skill, care and diligence, importantly, to be open and cooperative with the regulator and act in the best interests of the customer and to treat them fairly and professionally. But important to overlay on top of that an additional set of responsibilities with those who run the firms at more senior levels. That's actually far more important because they such hold positions of influence, and it's very important to call that out clearly. So what we expect or would wish to see then is that the senior executive team, and that's right up to the board and the very senior people, have a higher set of standards and responsibilities in terms of running the organisation. and we propose that it should be an obligation on them to ensure that the business is run responsibly and controlled effectively, and they can be held to account where that in fact is not the case, that they have to take steps that they're in compliance with the regulatory frameworks and that they oversee that work effectively. In complement to that, it's important that a business itself has a set of standards to which it must apply to, and we say that the next set of complementary standards should be on the business, so that the business is very clear that it too has an obligation to act professionally, honesty, with integrity and in conformity with ethics. Management and controls, financial prudence, client assets will all be part of that, and managing their conflicts of interest and the way that they communicate with their customers. But on top of that then would be a senior executive accountability framework where the very senior people in the organisation would have a list of responsibilities that would be ascribed to them, unavoidably then that it's very clear what they're responsible for, and on top of that then the firm would describe responsibilities. That would be complemented by a responsibilities map that the organisation would have to put in place. So there would be no more confusion or lack of clarity about accountability and responsibility. We see that as going to good governance.
Very finally, and one very final question, brief one if you can. Is there a sufficient focus now on long-term goals, long-term performance of the institution, rather than an over-focus on short-term performance, share price, dividend expectations, profitability and so on?
So, I mean, I think this is a fundamental part of the new philosophy of regulation everywhere is I mean, I think that honestly speaking, the kind of debate about short-termism versus long-termism is not really settled. But what is absolutely true is in finance, there can be a deep conflict that you can make profits today by taking excessive risk or by mistreating customers, and then the losses are down the line, and you might be retired or living on the beach or something. So in terms of compensation, maybe Ed can explain the clawback principle in compensation schemes.
So it is absolutely a core focus of supervision is the long-term sustainability of firms' business models. So there is a tension there between the short-term incentives and longer-term incentives. We would always endeavour ourselves to be taking a long-term view to make sure that firms' business models are sustainable over the long term, that they have sufficient resources to over that long term, including thinking about plausible stress scenarios. And from a remuneration perspective, as the Governor has outlined, for the banks, there are clawbacks for a number of years in terms of any variable pay that they receive. That's less relevant in relation to this, the likes of AIB, Bank of Ireland and PTSB, because under the legislation in Ireland they're not getting variable pay, but certainly that is very much part of the regulatory system now.
Thank you. Next, Doherty.
I just will begin with the tracker mortgage scandal. You mentioned that there's 3,200 outstanding individuals or families who have had money taken from them wrongly that haven't been returned, 2,000 of those verified. What is the delay in the banks returning the money to them and providing the compensation? Is it the banks, or is it the fact that there is 1,000 or 1,200 that the central bank hasn't verified?
The verification process is a process actually that the banks themselves have got to go through, and separately to that we will sample and check their work, so there's no delay being put into this from the central bank's point of view. The banks are able, if you like, to get on with this as quickly as they are able to do so. These customers were identified in the main after March of this year, and going through that process, the banks themselves have limitations of their own abilities to go through, and they must go through the work. we wouldn't ever stop them making payments. In fact, the opposite. We have been on them to get on with these payments within their ability to do that. We also, separate to that though, are checking that they're doing, for example, we go back and check the compensation and redress payments, and are they in accordance with what they should be, as well as other dimensions to their work. But we have been very strict with the banks to get on with it to the ability that they can. Some of them have limitations in this, but what I can tell you is that 4 out of the 5 banks are making substantial progress with that, and we have them all timelined to put as much pressure on them to get this job done, because it's very important that they do, and we accept that.
Thank you, Ms Rowland. Which bank is not making this significant progress?
I can't name out a particular lender, but it's very clear to us that our full focus has been brought on all of them to get through the payments as they should do, and give the money of compensation and redress back to the families and the customers that have been affected.
Can you give us a breakdown in relation to the 3,200 individuals that haven't been redressed so far? What is the breakdown per the individual of the 5 banks?
I can't give information about any of the particular.
Can you give the information without naming the banks?
I don't have that information.
It's fair to say the bulk of that is in one bank. That is true. So there is one bank which is responsible for the major proportion of what's remaining.
We heard before from the Central Bank in relation to Ulster Bank and the IT difficulties that they had, and this was causing a delay in making payments. We also heard last year when we were told that all of this would be paid in the first quarter of 2018, and now we're looking at the first quarter of 2019, where people will still be just getting their payments. That additional action could be taken by the Central Bank. Are you now proposing real action against banks who have been dragging their feet for the last number of years, and they've taken, illegally in my view, money from customers' accounts that still they haven't returned?
Well, as we've indicated, and we indicated to you before, there are live enforcement actions against all of these banks. So we don't want to comment in the middle of those enforcement actions, but those enforcement actions include how the examination was conducted. So when those conclude, we can say more, but all of that is under investigation.
Okay. In relation to the 3,200 customers, you said that the majority of them have been identified post-March. When was it, to your knowledge, that the last cohort of that makes up these 3,200 was identified? Are we still in a situation where last month people were being identified, or were they identified, was this 3,200 identified by July or June or so on?
I may not have the precise month, but it was more in June and July. But I can come back to you on that. But that figure, in order to be able to make payment, there's a process that has to be gone through to verify, because the approach is actually to identify groups of customers that have a common set of circumstances, and then they should be eligible for compensation and redress. But then it has to turn into an actual review to make sure that the customer can be specifically identified with the right account, getting the right number of people in that group, and that has to be done on a file-by-file basis. So that's why there's a bit of work to be done in that verification.
Is there any challenge or discussion between the Central Bank and individual lenders at this point in time in relation to cohorts of individuals that the banks haven't identified but the Central Bank believes should be identified?
There's no known outstanding issue between us and any of the lenders, but for sure, because we are on-site and off-site and looking at the way that the groups are constructed, we are bringing challenge. And as we go through that checking, now it has become less and less as the work has developed over time. We may surface extra people or challenge on the interpretation, for example, of the customer journey and the transparency requirements and the impact. But there's no outstanding issues between us and any of the lenders. But we haven't finished all of our checking work, so it's conceivable that if we think customers were excluded, because we're doing exclusion testing and we're doing reconstruction of the groups of customers, we're matching that then with the information we have about the customer journeys to see if there's any anomalies or exceptions. And in that, it is possible that issues arise, and they have been coming up when we were dealing with those.
Yeah, and I appreciate that. In relation to the number of appeals that are going through the Financial Service Ombudsman, and also court cases that are being taken against the institutions to ensure that they are adequately compensated and redressed, does the Central Bank have any indication of the numbers of people who have made appeals to the FSO, which have obviously exhausted the internal and independent mechanisms, and the numbers who have taken cases? And a follow-on question from that, if the Financial Services Ombudsman or indeed the courts find in favour of the customer, i.e. that they were entitled to additional compensation, will the Central Bank be ensuring that the banks review the entire cohort, those individuals with similar experience, to look at the appropriate compensation for that cohort?
Let me make one point, and then I'll ask Derval to follow up. So, before you get to the Ombudsman and the courts, just in terms of the appeals systems within these banks, what's interesting about what we're seeing is, although there's a limited so far amount of people taking appeals, a fair number are being accepted, and that's the whole point of why we're happy that this appeal system was set up. Because typically when an appeal is successful, it turns out it's something very specific to that family. There's some particular reason why that family has extra harm because of their individual circumstances. So the independent appeals mechanisms within each bank is delivering for those individuals who have particular circumstances. That does not rule out an individual or family wanting to go to the Ombudsman or to the courts. So I'll ask Derval to respond on that.
To exactly support what the Governor has told you, the appeals step in this process is one where in the main for the serious cases these are independent appeals processes. This is an additional step, an extra option that people have. They could have always separately chosen to go to the court or go to the Ombudsman if they wish to do so. It would appear like a reasonable option to try to see what this appeals mechanism would deliver, and there are people making appeals through the system, but they will have 12 months from the date of receipt of their offer to make that decision, so that's still something that will continue for quite some time. In terms of any decision with regard to a court or with regard to the Financial Services Ombudsman, we would of course expect that the banks themselves would be responsible and look at the outcomes that are occurring there and consider the reasons for those decisions. And if there is something that affects a broader group, that they would have to take that into account, because we have demanded that they look at their own outcomes in the appeals to see if there are systemic trends in that. Of course, in any case, it may be that there are circumstances particular to a family or to an individual that don't have any kind of general application, and that's the very reason why the appeal step is such an important one, because nobody can give compensation proposals in the general when they might have to understand what's happening in a family circumstance.
I understand that, but my question was twofold. One is the Central Bank aware of the numbers that have currently before the Financial Service Ombudsman or before the courts? And the second question was, the lead-on question to that was that if favourable opinions are given or decisions are given either by the Financial Service Ombudsman or the courts that would have a broader implication on not just the individual but a cohort of individuals, either that weren't deemed as in scope by the Central Bank or the bank themselves, or that the level of compensation was inadequate, will the Central Bank, as opposed to the banks themselves hoping that they do the right thing, which we know that they haven't done the right thing for the last 5 years in relation to this issue, if not more, will the Central Bank be reviewing those decisions?
The Central Bank is in contact with the Financial Services Ombudsman because we all form part of the financial services regulatory infrastructure. We have information that isn't in the public domain about the number of cases that are tracker related on hold before the Ombudsman. We've been in contact with him to be very clear that where cases wish to go and be heard in the Ombudsman, that that's the correct thing to occur. We are monitoring the outcomes at that system level to see if we can spot trends in that conduct. But at the end of the day, it will be for the businesses to right the wrongs that they have done to their customers, and they must be held to account for their conduct. So where issues arise, where there's commonality of cause from Ombudsman decisions or otherwise, all roads will lead to the banks. If they are responsible, they must fix it, and we'll certainly be having regard to that. But the effectiveness of that system must hold the banks to account for their conduct. and we are keeping an eye on
And
these
how
issues.
many cases are you aware of that are either before the FSO, and this is the third time I've asked this question, or the courts?
I can't provide that information accurately to you today because the information I have may change over time, but I'm happy if we could provide it to you as a follow-up.
I appreciate that. Governor Lane, you mentioned that the cost in terms of redress and compensation has been 580 million to date. We know that the cost in terms of the cost of the banks have been in excess of that. It was said by yourselves before that it could be up to €1 billion. Are we now past the €1 billion cost in terms of the tracker scandal?
Let me turn that to see if in terms of what the banks have put aside in their accounting treatment. Has there been any changes this year?
So it's in and around that number. There are they are making other provisions along the way in terms of other potential conduct issues, but it's in and around $1 billion in terms of total cost, including redress and the cost of the examination.
Okay. If I can go on to some of the recommendations in relation to your report, there's a number of key recommendations, but the problem is those recommendations were made before the report. We didn't need this report. You didn't need this investigation, and we've seen in terms of the methodology and the amount of work and hours that was put into it. But the key recommendations were actually recommended before that, as you mentioned, in terms of the review to the Law Reform Commission. I was hoping that there would be something far more substantial. Can I ask you, if any of the 4 recommendations or key recommendations were implemented, what would that mean in terms of individual accountability for the fact that nearly $500 million, in excess of $500 million, was taken from 38,000 customers wrongly? If you had those powers, would any individual within the banks be held accountable?
So, let me emphasise, maybe with the culture report, if you like, the recommendation about the accountability regime is turning to the Oireachtas in terms of extra legal powers. But in terms of other elements, there's a lot here in terms of it is a step forward in how we, in terms of our expectations of the banks, how we engage with the banks. And to emphasise, all of these banks have remediation programmes issued to them. So there are direct, in other words, we've learned through this culture report particular issues in particular banks, and that is part of our normal supervisory work, is to follow through on that. So we cannot discuss those bank by bank individual issues here. So maybe, if you like, the thing we have focused on in terms of highlighting is this legal change. And I think you would have seen various officials come before you or another fora saying mistakes were made. It's a passive voice, something, but they were unaware of it and all of that. Whereas the whole point here is really to flip the burden of expectation. Yeah. So you cannot, a senior executive under this new accountability framework, just as we are seeing now in the UK, cannot say, I didn't see that email, I didn't see that, I wasn't involved in that decision. If you are responsible for building the organisational culture, that's a heavy responsibility, and it means that even if you are not directly involved in some key decision, you can still be held to account. That's really it. It's the difficulty of establishing the chain of causation under the current legislation versus that.
I understand that, Governor Lane, and I'm finishing up here. Look, I've beat that drum for years in relation to individual accountability for bankers. We need that, but individual accountability for bankers where people see that nothing went wrong means nothing, because there's no accountability if the central bank can say something went wrong. So my question was to you, if you had that individual accountability regime, which is very clear about you can delegate tasks, but you cannot delegate responsibility. That's what I've been arguing for many, many years. Would you be in a position to hold individuals within the banks accountable in relation to the tracker mortgage scandal? And let me put another question to you, and I do believe, let me say this, and I acknowledge that it's not here that you made this original recommendation, it was done to the Law Reform Commission, but this is done in Britain 2 years ago. It's 2.5 years ago since it took place in Britain. There was a lead-in period to all of this. I think the central bank are behind the curve in relation to this here. I think, yous are very, very slow in coming to arguing for this to happen. And now what we're doing is just following what is already in place for a number of years in other jurisdictions. But let me put this point to you, Governor Lane. In Britain, the FCA has said not only do we need individual accountabilities and the senior management regime applying to senior management in the bank. They say we need to hold ourselves to the highest standards, and they have applied the same regime to the central bank. So is that the proposal as well, that there will be individual accountability within the central bank in relation to the failures that may present in terms of overseeing financial institutions in terms of consumer protection, or indeed in relation to prudential regulation?
Let me emphasise that we do have a parallel project in the bank to develop our own senior responsibilities framework. So if you like, you will see on our website when it's kind of completed, here's what the Governor is responsible for, here's what the Deputy Governor, the Director General. So in terms of the mimicking that framework, in terms of being clear about who's responsible for what, we've had a big internal governance project in the last couple of years to reform all of our committees, to be super clear about, again, the accountability lines within the central bank. So in terms of our performance as the regulator, we do hold ourselves to account. That is maybe a slightly different phrasing to the way you phrase it. If there's a failure by a bank, the responsibility, if we have failed, we will look at that. But if it's a failure by the manager of that bank, it is the bank that is responsible. We cannot guarantee that every bank is going to conduct itself properly at all times. So in terms of what the accountability is for, our accountability is for doing the best job we can as the regulator. It is not taking responsibility where the banks should be responsible. So, but in others, we do have this parallel internal project. I think one interesting thing, with the UK experience, if you like, I think it reinforces the case that we did wait. I'm not disputing maybe we should be quicker and all of that. I'm not disputing that. But now, when you go to look at this in the Oireachtas, if you get to it, you now have an evidence base. It's not just a hypothetical debate about whether this helps. You can maybe take testimony from the UK about how this has actually been implemented in the last year or two. Because there were concerns in advance about whether this would scare away people. Would anyone sign up to be a director of a bank with this heavy responsibility on them? So the kind of facts of life about how it's actually operating, we'll have some hard facts from the UK to deal with. But yeah, in general, I would fully agree with the FCA, and we're already on it in terms of saying, listen, if this is what we expect of the firms, we have to something like that for ourselves.
Can I ask a final question, just briefly? Do you intend to do a culture review in relation to the central bank? And because the central bank is made up of a lot of bankers.
We've actually.
I think the last comment by you was telling in terms of will this scare away bankers, as opposed to they stole €500 million from our customers and they haven't returned it 4 years later. And to a certain cohort,
Well,
we still don't have reckless lending. Reckless lending is still not illegal in Ireland. It's illegal in Britain, where they brought in these rules 3 years ago. We're still just talking about bringing in the rules, and I think the central bank needs to take the lead in relation to this here. Particularly we're 10 years on from the banking crash, which the central banker failed in relation to that. And I still am very clear as in relation to the issue of accountability, whether if you had a crash like that again, would we have a new inquiry where people would come in and say, well, it was the institution. Can we actually hold a central banker to account for example that they turned a blind eye to the fact that the concentration of assets in certain segments were way beyond what was required? That's what we're looking at in terms of the FCA.
Sure.
That it's not just about knowing that you're in charge of this and Ms Rowland's in charge of this and Mr Sibley's in charge of this, but actually if Mr Sibley fails or if another person fails, that we can hold you individually to account, or you will hold yourself individually to account, because it's not a systems failure, it's actually a failure of individuals, if that is the case.
I think I share that perspective. So I don't think we would have any ambition to be any less ambitious than the FCA. So, there's not going to be any less ambition here than for the FCA. Absolutely not. Let me say that the sorry, my train of thought has been interrupted. I think all that you said, I agree with.
Okay. We'll finish on a good point. Well, thank you.
Senator Rose,
Gurmagat Cahirlach, and thank you for your opening statement. I too just have to revert to the tracker mortgage situation to start out with, because what I'm finding from customers isn't in what we're being told here. When is the next update going to be on the tracker mortgage situation? Because customers are ringing the central bank and they're being told that there's no date for the next update. So maybe you just clarify that first.
The goal is a final report before the end of the year. So we do think, you know, I say there may be some cases going into early 2019, but by and large, as we said, 4 of the banks are nearly at the finish line. There's 1 bank with still distance to go, but we do intend to have another report at the end of this year.
But might I add that each bank who is responsible for communication with their own customers are required to have information and communication channels with those customers. So where customers want an update on their particular case, they need to be speaking to their banks, and we've been in contact with them about ensuring that they are placed to provide that information to their customers.
And therein the problem lies, because they're not communicating with their customers. And the customers are being bounced from their own bank to the central bank to the ombudsman and back again.
So so where you have information about that happening, I would welcome it, because we act on all types of information. Our clear expectation has been communicated to each lender about having information available for their customers, and so too we have been in contact with the Ombudsman about being clear about the process and information for customers. So if you have a particular specific issue to address with where that isn't working, we welcome that information, and we have been acting on that, because the information for customers will be available through each specific lender. The Central Bank of Ireland would not be able to advise on an individual case-by-case basis. We would never be able to advise on that basis.
But could customers who have been 3 years within this process since it was started out are absolutely at their wits' end in not being answered the most basic questions? I'll just give you one of the questions. Even, you know, on a tracker for months in 2007, then on to a fixed rate. The bank says they decided to go on the fixed rate, so it's nothing to do with us. You know, very basic things that the answers should already be established to. There shouldn't be any ambiguity about these cases. Other cases around the interest rates and what the interest rates were at the time. You know, a letter saying that the tracker averaged 7.9% when that interest rate clearly wasn't right. So they're still not, and what the banks are doing, and you need to know this, because what the banks are telling the consumers, it's the central bank lack of decision making that's holding things up.
I mean, statistically,
so that's how they're communicating.
What we have is 93% of the overall paid out, so there's a few thousand left. So there's 2 scenarios. It's either one of these cases is in the few thousand we know about and which are still in this final process of verification, or it's a situation where it's someone who's has questions about his or her mortgage, but which are deemed to be outside the examination. And I'm wondering if this is part of some of the non-communication is people who the banks have not included. They've decided these are not part of the group that needs to be redressed and compensated. But they still deserve a basic degree of communication from their banks.
So we've had specific conversations with each bank about precisely these scenarios. They are fully aware of our views with respect to all areas of this work, and they have been very clearly told by us to get on with communicating precisely the situation to all of the customers. We have been very clear with the Financial Services Ombudsman, who's in entire agreement with us, that any cases that are to be progressed, there is no impediment at all to communicating effectively with people to tell them whether they're in scope, outside of scope, what their options are, and to get on with progressing their cases. We were at great pains to make sure that that whole system of options for people was working, and there was nothing in the way of that working. And we have been very clear in communicating our expectations to each lender. So where that in fact is not translating into their actions for customers, it's very important that we have any specific information, because that's entirely contrary to our expectation, and our communications on that have been unavoidably clear.
Yeah, because so what appears to be happening is then when people are getting onto the central bank, they're being referred on to the Ombudsman. So that's the circle that continues on. How do you make sure that the communication between the banks and the customers is timely and accurate?
As I've said, we have set our expectations for the communications that the banks need to have in place. And the central bank wouldn't, if people ring us, of course, we'll seek to help them with general information.
But how do you check that the banks are doing what you're telling them to do?
So, I mean, that's basically part of our inspections regime. We have inspectors going into the banks, following up on all sorts of issues. So, basically, how we check on a bank about whether they are following through on what we require of them is through a range of interventions. So there's many, I mean, we have a large staff of supervisors who are there to really be engaging with the individual banks. But they typically, this is on the basis of, so sometimes there's kind of a, you know, if you like, you're going in and you might find something that you uncovered through some check. Other times you've got some information from maybe from a member of the Oireachtas,
okay,
maybe some other way. Okay. But we do act. I mean, let me emphasise again, when you do communicate with us, when there's something specific, we do follow up and we do make inquiries. And equally, if any customer makes contact with us with specific information, as in we can follow up. So absolutely, we do follow up. And this is why I would take a very dim view of any bank which is essentially misleading customers through their communication.
Okay. How many inspectors do you have?
Um,
And how often do they, I just want to get a picture of how often do they go out to the bank to check all of these things?
So there's a range of inspection teams that operate across the bank. So in terms of banking supervision, from a prudential perspective today, there are about in and around 45. There'll be supplementary other inspectors working out of consumer protection. We've also dedicated additional resources to going into the banks because of this. The nature of the tracker mortgage examination and the need to go into the institutions and make sure they are delivering as we expect. That's also been supplemented by third-party checks, both commissioned by the banks under our instruction, and also third-party checks that we do ourselves. So it's difficult to have a kind of precise number. It is scores of inspections that we full-time equivalents that are in banks on a regular basis.
So you've scores of inspectors, and they're not picking up the communications that we're getting and the consumers for here.
As the Governor has said, if there is information that you have that you can share with us, that we will absolutely follow up and we'll absolutely make sure that we're looking into it, and the banks are delivering as we expect them to.
I'll certainly do that. You refer to enforcement action. Could you maybe just spell that out for me, what the enforcement action would be?
Sure. Maybe I'll ask Derval.
So there are 6 open enforcement investigations in respect of the tracker mortgage issues. It is looking at the conduct of the business and any persons who may participate in that. That's the legal framework through which they look. And at the time that the tracker mortgage issues arose, to acquire evidence to see if any rules were broken and what is the evidence supporting that. They are looking at the conduct of the institution and the conduct of, it will be the senior persons who are in place at the time taking those decisions. They also are scrutinising the conduct of the tracker mortgage examination as the examination played out in the business. You heard about that earlier. So the behaviour with respect to how they behaved in the examination, redress and compensation behaviours, behaviours with respect to causation and other matters, and all of the different regulatory frameworks are being considered, and the evidence is being acquired and scrutinised from emails, minutes of meetings, interviews with employees and staff.
What happens at the end of that in terms of the enforcement? What are your choices again in terms of what sanctions are available to you?
So there's a range of options that could be taken into account. In the whole range of options could be that where there's evidence that the rules have been broken, one would have to consider all the relevant options. One of the main tools that the central bank has is the administrative sanctions procedure, where a case would be referred to a panel to adjudicate upon the matter and see if the case was proved in the way of a court case. And then the options that would be available to them would be options from fines to disqualifications of individuals where the rules have been deemed to be broken in accordance with the way that those rules are written, that individuals participated in wrong conduct.
Okay, and that includes custodial sentences?
Separately, where there are evidence of criminal offences, the central bank would have an obligation to report those to the criminal authorities who would adjudicate on those matters and bring cases forward. And though depending on what those offences were, if there was evidence of them, that would follow the court procedure, and whatever penalties the court system has adjudicated upon as being appropriate for those offences.
Have you reported any, as it is now, as criminal?
The central bank keeps that under review at all times.
But you haven't actually reported any cases as it is?
But certainly we have been in dialogue with the guards and the criminal agencies about these matters, and we keep that under close review.
Are you expecting that that will progress in the coming months?
We certainly are in discussion with the guards about these matters. That's our regulatory obligation, something we take very seriously.
You talked earlier about people who are subjected to the enforcement powers and people who maybe just disappear out of the system or, withdraw their applications and all. How do we know who these people are? Or are these people ever held to account?
Well, can I say that, first of all, we can pursue, whether you're in the system or not, the central bank and enforcement cases can pursue people who were involved in the management. In fact, that was a point that was fought about in the courts, and the central bank's view was the one that was favoured, that we can pursue people in enforcement cases who were involved in businesses who no longer are. But in terms of fitness and probity, the power for fitness and probity is limited to applying to people who want to work in the system or who are in the system. And actually we're seeking an extension of that, but we keep a record of all of that, and we keep flags and information, as is right that we do, about all of that. So if somebody wants to withdraw from an application, that of course they can do, but if they ever came back, we have a record of that information, and that would be ready to meet the challenge on a successive application.
Okay. You see what it seems like that a lot of the individuals within the banking system have a lot of places to hide, and then that the banks in themselves have a lot of places to hide because we don't get the information about individual banks. But I want to go on to the report just to talk a bit about. I think that report on the culture is quite shocking, absolutely shocking, and I would ask you if you thought it was shocking yourselves, because it's shocking to think that there are executives within the banking system who are paid hundreds of thousands, and there's banks making billions, and up to all of this is why it's connected with the tracker mortgage, all of this reckless business behaviour, and they don't even have clear lines. We're talking about clear lines of responsibility. We're not talking about a creche or a NINA or a voluntary organisation. We're talking about massive organisations, and it really speaks of an absolute toxic culture where nobody knew who was doing what or who was responsible for anything. It's bizarre. It is bizarre, you know, to read a report like this of the culture in it. And I do think that the language that's used within it does a disservice to the people who have been most impacted by the toxic behaviours and the lack of any type of management skills, even the most basic things of knowing who's responsible for what within an organisation. So you talk of, and I will, yeah, so thanks, Cahirlach, but you talk of insufficient attention paid to consumer interests. You know, insufficient attention paid to consumer interests. The language in it is feeding into the culture of let's protect the institution. And I get it that the central bank, you know, hasn't a direct line of responsibility for changing the culture within the banking system. But I would have liked to have seen much plainer language in this. In this report, it almost smacks to me like, you know, when you're reading an academic book on change management and cultural behaviour within any organisation. And I want to ask you, how many customer interviews were conducted in doing this this report?
Okay, well, let me turn to Dermot in a minute about that particular aspect of it. I mean, I think we should focus on the substance here. You may have a different writing style to our writing style, but the bottom line is what we're saying is this is not acceptable. Yeah. We're saying that this culture has to change, and we're saying through a combination of supervisory interventions that we are making already and we will continue to make and enhance. We think it would be reinforced by the legislative change we're recommending. So we would agree that this is not, and it goes back to that phrase, insufficient attention to consumer-focused culture. That is essentially, so in other words, in some minds of some bankers, this was seen as kind of, if you like, a kind of a secondary obligation, as opposed to being at the heart of how they do business. So this is, I suppose, the shift, the cultural shift that has to change is our conduct mandate and the expectations of the public are that they take their consumer protection obligations seriously, and that we all share. So I don't really think how we phrase it is the core of it. It's underlined by the actions we're taking, and as I say, that could be reinforced by this legislative change. In terms of how the customer perspective fed into the review, I'll ask Dermot.
Might I say precisely because we completely agree with you that it was observable that the behaviour that informed by the mindset of the banks was very far away from that which all of us would expect the culture reviews were undertaken. And the focus of the reviews then, because we saw the red flags in the tracker mortgage examination, the way that the compensation offers or negotiated with the central bank were absolutely not what we expected, and that we had to do more than 200 turns of challenge to get those up to any kind of a level at all, was precisely conduct in the wrong place. The culture review was undertaken, and it wasn't a focus on the views of customers in the public. Let me be clear, because we had already had a view on what that was, which was the very lightning rod for undertaking these 5 cultural investigations, which were very detailed, forensic, careful pieces of work with behavioural psychologists, prudential supervisors, conduct supervisors who focused on the senior leadership team of the banks because they are so significant in delivering from the inside out the mindset and the value that the business places on customers and how they put them, as they espouse to do so, at the centres of their business and the divergence of that. So the language in this report represents an overview of the specific lender reports, which each one got, but it has very important, significant findings, and we are meeting the banks at the boards, being very clear about our expectations, but the culture is for them to drive drive and lead from tone from the top. So the focus definitely was on the senior executive team and how they will ensure that they are clear about what that culture, that risk culture and that consumer focus culture looks like, and how they will embed it into their structures and processes. Yeah. And precisely because we do take it seriously, we are going to be in at firm level supervision, measuring how they deliver that. Do they look at the complaints that people are making and find the patterns? How do they train their staff? Are they making sure that their staff are in fact trained to give outcomes that are to the benefit of the customer, not to sell 20 products to them that generate more profit? And do they check to see what they espouse as the culture for consumer centricity is in fact being lived? And we think the proof of the pudding will be in the work that they do, and this will take time because clearly their behaviour has not been in the right place.
But see, I'm going to finish. I'll finish with this one sentence, and that is: you see, if this was a small or medium-sized business operating in the reckless way that these banks have operated, it is not a behaviour psychologist that would be brought in. It would be the enforcement authorities, and it would be a prison warden, not a behaviour psychologist. And that is the difference.
We have enforcement investigations open in respect of all of the lenders.
Thanks.
I just take up the point raised by Senator Conway-Walsh in relation to the report itself. So you carried out the report, you did 1,400 hours of desktop review, 500 surveys, 75 interviews. Now, bearing that in mind, and the fact that we're now 10 years from the bailout, just now, and we're reviewing this report, or we're discussing this report, isn't it absolutely horrific that right now in the banks they're behaving almost the same way as they did leading into the bust? Same arrogance, same method of operation, and no change to their structures. The other comment I would make is in relation to their customer focus. You know, you have all of the glossy ads that go out, the bank of you and all that sort of nonsense, and then you hit reality. So the reality is that I think it was 8,700 was the first figure that was used in relation to trackers, or somewhere around that, at the very beginning. And it has now grown to 38,400. And those that are still experiencing difficulties in finding a resolution to the tracker issue with their own bank, even though they're narrowed down now, will tell you that they meet the same aggression, the same bad manners, the same poor management, and the same determination to protect the bank at all cost, even if it's small money. That's what you have experienced 10 years on from the bust. And that's what we've experienced through the tracker review and the scandal that is. So the report, yes, it's timely. Yes, it tells us what an awful lot of us know, and it puts it in a reasonable language. But if you were to describe it in layman's language, you would say that the banks are still getting away with it. They're still treating customers badly. Isn't it amazing that you have to remind banks that are doing business with people that these people are their customers, and that you have to introduce certain protocols and sanctions and so on to make them view people as customers? I would say that the consumer would be utterly shocked that this report is now being presented and that there is further work to be done in relation to the sanctions. And I have to reflect on two other things. Like, you have a culture within the vulture funds in Ireland, within the banking sector in Ireland, that is truly terrible. It really is. I keep on saying it. It should not be tolerated in any civilised society. That's the first thing. The second thing is you have the tracker mortgage issue as the really big example of banks ripping off their customers and then more or less telling them, get lost, we're not going to deal with you. And finally, you have the proof from the EBS agents. The EBS agents followed your advice from the central bank. They followed what was required of them in terms of, looking after their customers and so on. And there are emails now that I have seen where those same agents, those very same agents, were being told by EBS to do what it takes to sell X amount of product each week. And that all still exists. So EBS agents haven't been dealt with. The trackers are still fighting their cases because, yes, 580 million was paid out, but there are significant numbers now in an appeal system or that have gone to the Financial Services Ombudsman. They're still there waiting to be dealt with. And you said earlier on that some of the recommendations that you would be identifying have already been part of the Law Reform Commission reports. So I don't see much change in the banks. I see some determination on your side to deal with it. But I would love for the central bank to say clearly to government, we suggest that you should have the following piece of legislation in place, and that it would be extraordinarily difficult for the banks to meet that standard, because that's what you have to do. But if you don't meet that standard, we're going to penalise you to the following extent and make you individually responsible. And you're kind of saying that, but I think you should be far more forceful with the banks, because, to be quite frank about it, they don't give a damn. They don't care. They're open for business. They're doing what you want, or what they want, and matters are not being resolved. And finally, just two things. GRG, that's another scandal. Another scandal that has yet to be dealt with. And Deputy Doherty raised a question which I think is very significant, and I'd put it in a different way, which is, if there's a disagreement between the banks and the central bank position on, say, a case like margin issues, which is PTSB and all of that, and there is one case that will be sorted and dealt with. With that, will the result of that case, the result of that settlement, will that be then, will that be applied to similar accounts? I think that's what Deputy Doherty was asking. So, and how will you establish that? And to what degree of accuracy will there be in the context of your approach?
Let me make one general point about what you said, and I think turn to each of Ed and Derval about some of the other issues. One way to think about it is, if you like, the gear shift in regulation, not just here but globally, is what we saw. I mean, these cultural issues are not new, but if you like, it was overlaid by a kind of instability issue also. So the reckless lending of 15 years ago, the fact that these banks basically collapsed, the fact that these banks needed extra capital, needed to change their liquidity funding, all of that has been, there's been a big amount of work to make sure that these banks at that level, at the macro level of aggregate lending, and remember we have the mortgage rules now, at the level of, are they making sure they have enough capital to stand behind their businesses, to make sure they're not overly reliant on short-term funding. Those kind of macro issues are being dealt with. There's been a lot of progress. But with the stabilisation of those indicators, there's now more visibility of these more hidden issues, such as how they treat customers. Because so the good news is it goes hand in hand. the fact that these are now in better shape at a prudential level allows us to change our supervisory priority towards looking at a higher level of ambition in terms of not only are you safe, but also are you adhering to the standards we expect you to adhere to in terms of customer focus. So I think this is if you like, it's a new reality now, which is this is the next phase of supervisory focus because of the fact there's permanent challenges to maintaining stability, but at the very least, when they're now in better shape, we can do more in terms of focusing on these customer treatment issues. Let me maybe turn to Ed to talk about the issue about well, let's see what response you have to what Deputy McGuinness said, and then I'll turn to Doherty.
So, I mean, to just echo, reinforce a couple of the comments the Governor's made there. I mean, there has been a fundamental shift in the approach to regulation of the banks, and indeed other financial institutions, and the supervision of them. But both on a prudential or safety and soundness perspective and from a consumer protection perspective in terms of both the rules and the supervision of them. What we have found, and this is a global issue, is as well as addressing through the rule book, there is that, as you describe it, a driving need for the culture to change within these institutions. And that's what we're very much focused on. We have been focused on for a number of years. There is the lightning rod of the tracker mortgage issue is it comes into very sharp focus how important it is that not only are firms complying with the rules, but they are actually thinking about the risk and thinking about their customers to a much greater extent than they have in the past.
So the global phenomena of misconduct scandals has been clear in this jurisdiction as with others, and the culture report gets underneath the issue in a way that is different to the enforcement actions. Will be backward looking at breach of rules, but the culture report gets inside the mindset of what's really going on, and what's insightful about it actually, it's the words and the thinking of the executives themselves and the teams who report to them. So for the first time you have an insight into what's going on inside of their own thinking that motivate the outcomes that you actually see for customers that you think are unacceptable, but it explains a bit of why we are in this place. So actually, for change to happen, the businesses themselves need to accept that they need to be in a different place, they need to know what the problem is, and they need to come up with a very detailed set of approaches that are meaningful, that will deliver that changed outcome. And we are getting deeper and closer in our intrusiveness in conduct regulation, and that's actually the phenomenon that's occurring here. So we will be evaluating, we're meeting the boards and we're evaluating the risk mitigation programmes, and we'll do that with our colleagues to make sure that we think that they are comprehensive and deep enough. But that then will require those businesses to apply those and deliver that, and the jury is out on whether you can expect that to occur or not, because our evidence of our eyes is different to that espoused ethos of consumer centricity that we hear about. But in fact, because we see that, we are practicing sceptical, intrusive supervision, and the consumer protection risk assessment approach that we know will have to be put in place is that we expect those firms to have a comprehensive conduct risk framework in place so that they know when they're taking decisions at the board about new markets to enter or strategies, when they look at profit versus consumer interest, that consumer interest is properly considered and put to the centre of that. And when they're designing their products, they don't look at the product that they have that they would wish to sell to customers in order to generate profit. That part of that thinking is equally what is the benefit to the customer and who is the target group, and are they selling to the target group? Because it's only through that breaking it down into its component parts of the way the businesses are governed, the way the products are designed and sold, and the training and incentives to staff, can we see the real change being effected? So we recognise we're going to have to get granular and very detailed, but the obligation is on the businesses to change. So the culture report is a different kind of an intervention to the enforcement cases, and in order to effect the change that we would wish to see, they will have to embrace that. But we know where the key transmission points to customers are in the sales process, and we know where the deficit of thinking might be in the board level process, and we're going to have to check that to make sure that the businesses are doing what they should to develop their consumer culture.
And just in relation to the EBS agents, tight agents and that, isn't that an example of where the bank could have investigated that deeply and taken serious action because of those emails that I have seen?
Well, certainly, in terms of the information that's been presented to us and engagement from those EBS tied agents, we have absolutely looked at it. There is, as I understand it, a commercial dispute between them and the bank that is ongoing. In terms of the underlying issues, we have the information, and we have of course investigated it.
Is your investigation completed, or is it an ongoing investigation?
So we have looked and we have looked at the information that's been presented to date. If you have further information, as we always say to you, if you have further information for us, then we will look at it.
But can I ask you, is the investigation ongoing, and will there be sanctions, or is the investigation completed? Are you finished with the investigation?
It's very difficult to answer that question precisely because we're talking about a specific firm. But I am satisfied that we have looked thoroughly at the information that's been provided to us, and we have formed a conclusion on that information that's been provided to us.
So are you finished?
Well, I've said that we have concluded based on the information that we've been provided with.
You see, that's where the problem is.
So
because there was no sanctions. So
there is, in the case of the EBS tied agents, there is a commercial dispute between EBS and AIB as it is today.
I'm not disputing that. I'm simply saying that there was an issue here with the EBS agents. The emails that I have seen support the case that was made. They clearly say, do what it takes to shove this product or that product. And they've presented the central bank with the case. There has been nothing, no sanctions.
Well,
that is what tells you about the central bank. If a case is made, GRG, for example, similar to the EBS agents, they've gone halfway around the world to try and get their case heard and get something done with it. Lives have been destroyed. Families have been destroyed. It's the same case with the banks. And it would seem to me that, it's softly with the banks. But those voices that are out there shouting about particular instances of, wrongdoing, they don't get heard.
I absolutely contest that we are going softly with the banks. There are two distinct issues that you raised there. We have looked at the information that's been provided us by the EBS tied agents, and they are in dispute with EBS AIB as it is today, and that is a commercial matter
that's just a cover.
It's not a cover.
It is a cover.
That is the fact of the matter.
Anything that happens here where the banks or where the central bank want to, push it to one side, we're told, that's a matter that's being contested in the courts. EBS tell us that, AIB. So therefore, we can't get to the end of it. They won't get to the end of it. And they hope that over time, those that are making the complaints will simply fall away. It's the same way with the customers. Let's put this straight, Governor. 8,700 was the original figure, or thereabouts. If it wasn't for the people who came forward and gave evidence at this committee and the work of this committee, we would not be where we are today, because the banks would have rode roughshod over every single one of them and not give them a leg to stand on. And that is the disgraceful nature of banking in this country. And if it was properly supervised, the vulture funds wouldn't get away with it, and the banks wouldn't get away with it. But because of the fact that we lock ourselves into a straitjacket of a law or a regulation and you can't do it. You can do it. And if you can't do it, go back to the Minister and say, we need our powers improved to kick these people into shape before they do further damage to families and communities around the country. That's my strong belief on it.
I appreciate that. And let me, we cannot overemphasise. I mean, our role is clear. We are here to serve the public interest. We are public servants. We are crystal clear. Our only agenda here is to serve the public. So, I mean, definitely, we have no difference in our objective between us and I think the members of this committee. We share the same objective, and I would just urge you to, bear that in mind. When we operate under certain constraints, legal constraints, supervisory constraints. So I can appreciate it's sometimes frustrating when we can't disclose all that we do, but that's the intrinsic nature of supervision. But the underlying objective is the same. Now, in terms of how the tracker examination unfolded, we've previously given and acknowledged, I think it's been very helpful that you've brought in the banks repeatedly. That has been very helpful in shining the spotlight. But the ultimate, when the number you cite in our original reporting, we adopted a conservative reporting approach, which is just, here's the numbers completed. It was never the case that, and it's a mischaracterisation to assert that this was the move from 8,700 completed to where we are now. This was always the journey we were on. Essentially, we were always determined to see this out, and that's borne true. But absolutely, we are very grateful that the Oireachtas has supported that through this committee, and equally the government has supported that through its interactions with the banks. And that should never have been necessary. I agree with you. It should never have been necessary that the banks, we were very and as part of the enforcement actions we're looking at now is, why is it the case that they did not comply without obstruction to our requirements under this examination? So, I think it's very important, and it's very important for the public listening in to really appreciate that our job, day by day, is absolutely the only agenda we have is to serve the public interest, and we do that within our mandates. And when we every day there's all sorts of things we're dealing with, all sorts of interventions we make, most of which never become public because it's not the nature of supervision that all of our interventions, all of our actions are public in nature. But so this does require, it goes back to the, and I appreciate that in the same way with others, we have to demonstrate for you to gain more trust in what we're doing. We have to demonstrate that in terms of the outcomes that are achieved. But I suppose, I would ask you to accept that we have the same objective here. We're absolutely, and we have no reason, we have no reason to go easy on the banks. Our job is to, where we identify problems, is to solve those problems. How we do that in terms of the different ways we do it, not everything is made public. But absolutely, we share the same objective here.
I'd suggest, Governor Lynn, I'll finish on this. Senator Burke wants to come in. I'll finish on this. I firmly believe that the tracker mortgage issue and the other banking issues would have been dealt in a different way if this committee didn't expose them. And I would further suggest that the banks should be named and shamed. Whenever you investigate and whenever a wrongdoing is found, they should be named and shamed. Put out there in the general public, like for example the EBS one. The email of 2008 states clearly to those agents, this is what you should sell, this is the numbers that you should sell, you can make money, go out now and do it. Do what it takes to make the money, regardless of what you were selling. And I would have thought that to gain the public confidence that's needed, to tell the public what you've done in relation to cases like that, would actually be supportive of your position. And if the legislation is not there to support doing something like that, then please make the suggestion to the Minister as to how they can improve the legislation. Because believe you me, the ordinary punter out there, and I put myself in that category, believes that the banks are getting away with blue murder in this country and no one is prepared to take them on. And they look to the central bank. So if I'm wrong and we need more legislation, please tell us. But I firmly think that as you talk about building the trust being built between the bank and the customer, there's a huge job to be done in terms of building trust between the central bank, the ECB and the individual.
Let me emphasise again, I would agree that our track record is the most important element in building that trust. And as Derval said earlier on, I mean, look at all we're doing, the amount of enforcement actions we've concluded in public, the amount of effort, as Derval mentioned. I mean, some of what we do is, you know, we cannot make public that such and such a person attempted to join the board of a firm and withdrew or was turned down by us. That's happening all the time. In the aggregate, we disclose some numbers, but we can't say this individual, you know, for various privacy reasons. So it is. There's always going to be what we can do in public, and where we can, we do make that public announcement. One interesting thing we've done in the last few years is when a certain individual may face some prohibition in the legal infrastructure, that could be done privately or could be done publicly, and by and large we're doing it in public. So you will see the periodic announcements, such and such a person has received a prohibition. That's because we do want to, when we can, we want to make public what we're doing. We do have that commitment to what we do.
So how many cases have been withdrawn? Did you say? You said earlier on.
More than 50. So.
And how many other cases then?
So.
Did you say there was 1,200?
More than 100. I think it's 122 enforcement cases have concluded. Our policy is and always has been, where we can make an outcome public, we do. And it has been a key driver in our approach that transparency is really important. There are times when we can't give out information because, and Ed might speak to this momentarily, professional secrecy and European confidentiality regimes apply to us the same as all the European countries, where we can't put information into the public domain, or where there's disputes or various points of view, and there is some information in the public domain. It's not always able, we're not always able to comment on the rest of that. But where there are enforcement outcomes, or where we can make things public, it's been actually really important to us that we do so, precisely because the more that the public can see the outcomes of the cases, and actually we put quite a lot of detail about what happened and the penalties and what drives the penalties and the behaviour that's being described into the public domain. So it's not just the outcome, it's the story with that, because we know that that will be the investment in seeking to build trust and inform the approaches. And where we can't put a particular case information out, we try to put information in the aggregate as we have done so, and it's an absolutely key part of the way that we approach regulation, because we see that it's very important that our approach is understood and trusted to the most extent possible, and we recognise that isn't so easy for us to be understood. But we are absolutely driven by our aim to deliver on our mandate in the public interest, and it's core to how we do our work and how we view what is important and what is serious.
So, just to echo that, I mean, our stated aim, our actual aim in terms of how, certainly from a financial regulation perspective, we interpret that public interest that we are all working in the central bank for, is that we have a financial system that serves the needs of the country and the people of the country. And what we have done with the culture report is we've shone a light on some aspects of behaviour and culture within the banks that is not acceptable, and we're trying to drive the change through that.
Okay, Senator O'Donnell.
My apologies for being late, John, but thank you. Just a couple of quick questions, really. Firstly, this particular study was around the culture in the banks, right? and around how they dealt with customers. How many consumers or customers did you interview as part of your report?
Okay, let me turn to Derval again.
So actually, this report wasn't based on customer interviews because we already had seen a lack of consumer focus as a result of the tracker mortgage behaviours and others. And what we did was focus on the senior executive team and the way that they approached decision-making, their mindset and their business, so that we could really, through the culture report, get into their thinking about how they take decisions. And what happened was, during the initial phase...
We have limited time, right? For me, I suppose I'm coming back. We're dealing with customers and we're dealing with constituents. They still believe they're being very badly treated by the banks, that nothing has changed. Now, I'm asking, as part of the tracker mortgage issue, I'm a believer in primary research. Primary research is going back to the consumer. So in terms of both the tracker report and this cultural report, did you engage directly in interviews with customers of the banks?
No, we didn't engage directly because the insight was that customers of the banks were not being treated in the way that we expected.
How can you stand over a report when the very people that the report is about were not interviewed?
But, Senator, excuse me, the amount of information we have on consumers, the flow of information we get every day through the public contacts unit, through letters to me, the amount of information we have accumulated, it would have been redundant and wasteful to essentially take a step which we take every day, which is listening to consumers. We know that I don't think there's any lack of insight into the fact consumers are deeply unhappy with how they're treated. So if you can share with me what you think was missing in terms of...
I'm just looking at it this way, right, is that we undertook 1,400 hours of desktop reviews, ran more than 500 surveys and conducted 75 interviews, right? Now, if none of those were with consumers, right, I, as a public rep, have to ask the question that before we came in here today, I got a phone call from a customer of one of the banks who has asked me, knew that you were before the committee, and asked that I'd put one question to you. This is a consumer who's been dealing with various banks to pose the question, did you conduct interview with consumers? And furthermore, to ask the question that, did you consider that the banks were engaging in a form of moral hazard themselves, that if they felt their loans were going to be bought by funds, or as now known as vulture funds, that they effectively did by stealth non-engagement with customers, bank customers, because they knew the loans were going to go to the vulture fund, a bit like the bank guarantee being a backstop when the bank guarantee happened. And there was a view taken by many of the public that the banks knew the state would bail them out at the time, and they engaged in reckless trading, which lending everyone agrees to now. So the question I'm asking is, I'm disappointed, and I believe the report is lacking because customers were not... I'll finish my point, then you can come back. Secondly, could you address that point about moral hazard in the banks themselves, that if they were of the view that their loans were going to be sold on to vulture funds, that they deliberately engaged in constructive non-engagement with consumers? And thirdly, on the tracker issue, do you believe that the banks allowed the tracker issue to continue because it was adding to their bottom line in terms of profits at a time when their balance sheets were extremely vulnerable, and they took the view, let's ride on, let's rip off the tracker mortgage, and sure, if eventually we're caught, we'll effectively pay up. So you, for want of a term, you do first and you explain later, rather than explain first. So can you deal with those 3 points? Because ultimately our role is a questioning role. I acknowledge the work the central bank do, but we have to provide probity in terms of the work you do.
Absolutely. So I mean,
and I believe, would you address the issue of my disappointment and concern around the lack of direct engagement with customers of banks regarding a cultural issue? How can you form an impression if you're doing 1,400 hours of desktop reviews, 600 surveys and 75 interviews, and none of those with bank customers? How is there not a gap in the due diligence and veracity of your report?
so on that, let me just say that, I mean, there was no question. I mean, I think if we had some question, if we went into this saying, well, maybe they treat customers fairly, and maybe we should check with customers.
Well, am I correct in saying of the 1,400 hours of desktop reviews and 500 surveys, 75, none of those were with bank customers? Who were they with?
Because this is about the conduct of the banks. I mean, there was no, we were not
But how could you assess the conduct of the banks if you didn't, at the same time, have the other side of the equation in terms of
as I said,
that's the primary research.
But that's we do that every day, and there was no question about the nature of that research. But let me.
This was a standalone project.
So, if there is no question that the banks have treated their customers appallingly in relation to in relation to trackers, there is no question of that. The scope of the work was to very much look at the behaviour and culture within the banks themselves.
How can you do that without talking to customers?
If you let me finish.
Yeah.
One of the key aspects that we can see in doing that work is the distance from the executive, from the boards that are making decisions that impact on customers and the customers themselves. So we can see the distance within the banks, between the banks and their customers. We can see the impact that has had on customers, as I referred to earlier, with the lightning rod of the trackers. And we see every day.
With due respect, Mr. Sibley, right, in my experience dealing with banks, the people who are the front-end staff dealing with banks, they are getting the direction from the board, from top management. Sell products, meet targets, right? So to say that there's a disconnect and that effectively that the boards are above in some ivory tower.
That's not the point I was making.
But the point I'm trying to make is, I find it difficult to comprehend that you can come out with a report on the cultural treatment by banks of customers and not, with all these interviews, 14 hours of desktop reviews, 500 surveys, and conduct 7 of it. Now, one of those was with a bank customer. If I'm doing any report, you're surely going to have primary research. And the primary research, there's plenty of it in terms of the banks themselves. But in terms of how they interact with the customer for yourselves, you appear to be basing it on the feedback in terms, right, people would ring the central bank. But I would have thought the person who wrote the report, who actually physically wrote the report?
Let me turn to Gerry.
So there's a lot in what you're saying, and I really want to tell you.
It's the customer. The bank customer is the person I'm interested in.
Can I make this, we've been clear that the customers weren't interviewed. The purpose of the report was to identify the cultures that were in existence inside of each of the lenders. There was a particular focus on the senior executive team, precisely because what you say is correct. They are so important in leading the culture, the attitudes, the tone from the top, that the rest of the employees and staff will follow, that to understand their motivations, their value set, their mindsets was the focus of the culture report. As Ed and the Governor has already said, we were aware that there was a significant cultural and behavioural deficit in the way they behaved towards their customers. So the report was to focus on how, at senior levels, the bank itself values the trade-offs in decisions between, say, income on a particular initiative about a whole variety of different things, such as new products or market share, and how the customer is valued inside of that. we not only looked at a team from leading experts, world experts in cultural evaluation from our colleagues in the Dutch Central Bank came over here to work with our own team. We took a blended approach to their established model to look at the mindset and the behaviours and the group behaviours inside the organisation. We blended it with our own behaviours.
I fully understand that. I'm a practical person by nature. And if I want to know what's going on in a company, and in my old, when I was previously operated as an auditor, I went to the person on the floor. I said, tell me what's going on the floor. I didn't go to top management for everything. And I would ask customers, the question I suppose I'm asking is for me looking in, I have to ask why. You say you're aware of customers. Why, as part of a completeness of the report, that you did not interview customers of the banks across a range of the banks as how they felt the banks were dealing with them, and that you got first hand? Because in a lot of cases, if you go to the person themselves, it can be sanitised up along the line. But if you get a person into a room and you sit down and you say, tell me, what was your experience with Bank A or Bank B or Bank C? There is nothing to substitute for meeting the person and interviewing the customer themselves.
Well, can I say that we did go beyond the people at executive level, and the insights we got was from questionnaires and witness interviews with people who work for them and underneath. So we got a view of how a decision was made, what was valued inside of that decision, and the outcomes in this report, which call out exactly what you're talking about, which is a journey to travel in terms of actually being the consumer-focused organisations that they need to be, and a deficit to be filled in terms of their structures, and embedding that is the insight and the outcome that was gleaned through this process and this approach, which in my view has effectively given us the insight, which it may be something that you thought was in fact the case, but it's confirmed on an evidence basis that it is the case. And it is because the rigour of looking not just at the executive level, but interviewing others in that approach below them, and that was part of this, the staff perceptions of what the executive team valued and the insight.
The two final issues. The issues as regards that many customers believe that ended up in the vulture funds, that the banks stonewalled them when they were looking to deal with restructuring their loans, because the banks had the backstop of knowing this loan could go to a fund.
So let me say, make 3 points. First of all, let me just come back to this issue about customers. If we were starting with at point zero, or having come to this cold, of course you would have to do customer interviews. But we have so much information from customers already that, so it was not a standalone project. It's integral to all that's come before. Second, we are within that. We do think it's very important for these banks to embed the information to be gathered from customer surveys, focus groups, surveys. So they need to have mechanisms at board level to absorb what they learn from customers. That's part of this cultural shift. The 2 points you make, one is, I think it's a basic point is any customer in arrears under the CCMA, the Code of Conduct, the banks have a responsibility to be proactive in engaging and trying to resolve those. So, if you again have evidence that any bank or in any case neglected that,
Customers, constituents are telling me this.
So let me make 2 basic other points. One is, it's very different to I agree with you about the moral hazard of the bailout, not just here but elsewhere. That was part of the mindset going into the crisis. But in that situation, what they were counting on is for the taxpayer to step in, which happened. There's no taxpayer step in this situation. When they, if they have not dealt, if they've left a customer...
Can you finish the final point? Can you deal with the point that they stood idly by and were not proactive, that it suited the banks to allow the tracker overcharging to run on, because it allowed them to boost our balance sheets at a time when they were extremely vulnerable, and as far as they were concerned, we can literally ride on and explain later.
So I don't want to. This is part of the enforcement actions we're taking on. Is exactly how these decisions are making, and so I don't really want to preempt the enforcement investigation. But more generally,
where are they at the moment, Governor? Where are those enforcements? Will you be procedures in place against the banks? Where is that at the moment against the banks?
It's in train. It's active. There are timelines, but we.
When do you think you'll be bringing sanctions to the banks?
You know, I think it's a mistake in any enforcement investigation to put a deadline, because.
But when do you expect you to conclude it?
You know, we have timelines, but it's not the case that these are going to conclude within weeks. But we do have.
By the end
I
of the
don't really
year?
want to say because of the fact that's part of the how these enforcement actions.
By the end of the year, next 6 months.
I don't. There will be nothing. I think unlikely in 2018, but.
2019.
I don't wish to give specific timelines on the enforcement cases because there are.
In general terms, when will you conclude it?
They should run because they're long. These are long and detailed investigations. Yeah. I wouldn't expect outcomes this year. Okay. But they're on different timelines. Some are more advanced than others because we started them earlier. We're getting documentation and interviews done quicker in some. Some have different kinds of obstacles in them. But the commitment to rigorous conclusion is more important than deadlines. And the deadlines, because enforcement cases can meet obstacles and different issues. But they're all timelines.
I'm going to finish on one quick point. The problem here is that the customer got ripped off on the Trapper mortgage, right? They're looking in and they're saying the banks, as far as they're concerned, have not changed. Sanctions have yet to be brought. So the question is, there is a need for closure on this matter. And the customers and the people that we deal with, the people on the trackers, the people on SMEs, the small businesses going over to the funds, this is an issue that they're entitled to closure. This has run on at this stage for 10 years. We're now celebrating the 10th anniversary on the bank guarantee scheme. They're entitled to closure.
We all want to close as much as possible, as quickly as possible, but I'm sure you can fully appreciate if you set a deadline, you just encourage banks to run down the clock, you know, through obstructionism. So we can't have a situation where we impose a deadline which leads to a worse outcome for those affected. But remember, we have over 30,000 customers who've received their redress and compensation. A lot has happened. It's very important to say that. A lot has been delivered, but we are committed to being complete and comprehensive and not leave any stone unturned in bringing all of those who should be repaid and compensated from the tracker. The more broad issue about, we had an earlier discussion about 10 years later since the crisis. There's a huge amount has been done. The world of regulation is vastly different to 10 years ago. And if you like, in terms of one of the, I think, byproducts of the fact that banks are now stabilised is we are able to do more in terms of holding them to a higher standard. It's not enough for them to be prudentially safe. It's also necessary for them to demonstrate their commitment to good consumer outcomes.
Thank you. Thanks, Senator O'Donnell. Senator Burke.
Thanks, Chairman. I'd like to welcome Governor Lane and his staff to the committee. I have a couple of brief questions, and just to continue on from what Senator O'Donnell said. What Senator O'Donnell said that there was constructive non-engagement with banks, with their customers, who the banks felt that these loans were going to be sold to vulture funds. Now, you have come in here on numerous occasions. You have told us to tell the customers out there to get proactive and to work with their banks, to go to the banks if they were in difficulty, to go to the banks. So, have you found in the reports that you're looking at, and you say the report is concluded, and have you found that there was constructive non-engagement?
So I'll turn to Ed to give you some of the details about this. But a lot of restructuring, a lot of engagement has happened. Many mortgages have been restructured because...
We know all of that, but have you found out the specific thing that Senator O'Donnell has said? Was there constructive non-engagement where the customers' loans were going to be sold to vulture funds, where the bank felt that these were going to be sold? They closed down the working with the customer. Have you found out that?
That would be a violation of the Code of Conduct if the banks have a duty to constructively engage with the customer.
Have customers written into you in relation to this issue and informed you that they have tried to engage with the banks and that the banks won't engage with them?
So this is just to be clear. You're talking about in connection with those loans that are in difficulty, as opposed to the tracker mortgage issue. Just so I'm clear in terms of the question.
What I've said was continuing on from what Senator O'Donnell has said in relation to constructive non-engagement by banks in relation to mortgages and in relation to all types of loans, that there was difficulties with.
Okay, so we have seen no evidence of that, and in reality, the evidence points entirely in a different direction. So if we look at what's happened in terms of the level of distress,
so there was full engagement between the banks and their customers on all occasions. Is that what you're saying?
So in terms of what we have seen, if you have evidence to suggest something else, then of course we would look at it. But in terms of the approach that's been taken to resolving mortgage arrears, which I understand is your question, then we have required the banks to be making sure that they are engaged. We've required banks to be making sure that they are addressing as soon as possible, engaging with their customers in a way that respects the customers, as is outlined in the CCMA.
The members here,
if I can finish,
yeah.
We've required banks to make sure they have a waterfall approach to make sure.
We know all of that, but the members of this committee on several occasions, all the members have said that there was problems with engagement between banks and customers, and you have said that you have found that there was no problem between engagement between banks and people who had problems.
As borrowers that have been in distress have engaged with their lender, that absolutely loans have been, their individual circumstances have been considered. Absolutely, they have where restructuring has been required. That has taken place. Now that isn't a straightforward exercise. So that requires engagement on both sides. It's not a straightforward exercise, and there is judgment associated with it. But we have not seen evidence, in terms of the question from the senator, that banks have been stonewalling around because they think that the loans might be sold in the future. In fact, I would say that they're not incentivised to do that at all.
You make that judgment when you haven't interviewed the customers as part of this survey, this study. How can you make that categorical statement?
So there's a number of different points that are being made here. You've asked about the approach that was taken to the culture review. We undertook a piece of work on the culture within the institutions today, and through that, the methodology, which is supported by the world experts in this, we undertook a survey, a review of the culture and behaviour within the banks. Separately, we undertake a huge amount of work in terms of the ongoing engagement between banks and their customers, be it on specific tracker issues, be it on non-performing loans, and what we see and what we require is that they engage with borrowers that engage with them. There is a big issue around engagement, and it does require continued diligence, continued focus, both from the lender side and from the borrower side.
In relation to the EBS agents, the EBS was taken over by the AIB, and we had those EBS agents in here, and it was alluded to by the chairman here earlier on. Will the report deal with how the EBS agents were treated in relation to after the takeover by the AIB of the EBS?
So the culture report focuses on the culture in the institutions today. There is a historical dispute between the EBS-tied agents and AIB or EBS, depends how you describe it. That's a matter that's going through the commercial courts. We had a discussion with the chair earlier on this matter, but it's a separate matter to the culture report.
Yes, but quite a number of the banks that were in here, and they said that they're going to grow their business rather than opening outlets in various towns throughout the country. They're going to grow their business through agents. So will the report deal with a recommendation for banks that are going to employ agents to sell their products?
I mean,
as to how, in the aftermath of what has happened with the EBS.
So we recognise the risks associated with indirect agents, so brokers in general, and the risks associated with having that gap between the bank and the customer. And how that works, I think is something. It's a clear risk factor that we do monitor. Our consumer protection risk assessment model absolutely looks at sales channels, and ultimately the responsibility is on the bank. In the bank, regardless of whether they are selling something directly or through an agent, we hold the original bank to account to make sure that that sales channel is safe for customers. So this issue is absolutely, as Dermot said earlier on, I mean, the sales process is the key point of vulnerability in many times to consumer protection. So this is a very high priority for it, but maybe Dermot could say something on it.
So the Culture Report completely recognises that the banks, all of them, have a distance to travel in embedding into their practices and their structures a true consumer focus. And the report goes on to articulate how clear we are that in order for them to be effective and deliver the outcomes that we all expect for customers, they need to have a full and comprehensive understanding of the risks that their business poses to the customers, and they need to have a plan to address those risks, to mitigate them. Part of that will be the way they design their products, the way they incentivise their staff and or agents to sell those products, the kind of training people are given and the expectations that are set. And we are very clear that as the understanding of conduct risk, of the risks to consumers is fully understood, that you have got to look closely at the approaches that are employed and adopted by businesses when they are selling to customers, and that is definitely one of the parts of the risk framework that will be more closely scrutinised. But of course, they'll be expected to know their own business model and to put appropriate risk mitigation in place to deal with that, but we will be checking that they do so.
But irrespective of the commercial dispute that's going on between the EBS and AIB, the report isn't going to deal with the specific issue at all, is it? It's going to sidestep it.
Well, this is the report that we published is a report that looks at the culture of the banks with a forward-looking analysis of what needs to happen and an expectation that the banks will be held to account to do that. Each bank themselves had their own specific report that is more particular to them, presented to them. It doesn't particularly specifically look at the EBS agent issue. That's another issue. I think Ed explained earlier that there are a lot of issues that arise in the banking system that have to be dealt with. Not all of them fell within the scope of the scrutiny of the Culture Report. The Culture Report was in effect looking at the trade-offs that the senior executive team take when they're looking at the more income part of their thinking with their risk thinking and their consumer focus. And it was with that lens the report drew its conclusions.
Yeah, finally, Chairman, in relation to credit card interest rates, we have seen now recently where some credit card companies are charging in excess of 25% interest rate. Now, all of the transactions that are carried out by credit cards, and every single day there's more and more credit card transactions. We're going to a moneyless society, tap and go, and you know, when you think of all the billions and billions that's spent and paid for by credit cards, the amount of money that they must be taking in, because they take in a share, they get a percentage of the turnover of the country.
Report first, Senator.
Yeah, but just finally, Chairman, I think it's in relation to consumer. This issue would be: have you any complaints received about the 25% interest rate that the credit card companies are charging? Because we had to deal here with money lenders, and this, in my view, isn't much above money lending, because of the exorbitant interest rates that they're charging. And we've seen quite recently in this committee where the Post Office could bring down the price of mortgages if they could get into the mortgage area. So 25% is an exorbitant interest rate. And have you received complaints in relation to it?
I'll turn to Dermot in a second, but let me emphasise in terms of coming back to this issue of how we think about consumer risk. I would agree with you that credit cards are a clear priority area because of the fact that essentially the temptation to spend money now and not worry about the interest rate until later. I think the global evidence is absolutely how those credit card contracts are designed are a source of risk for consumers. So in general, the credit card system is something we do have to monitor. Again, remember the way credit cards work is a lot of people pay off their debt within the month. So there's no charge for that. But then you do have this high interest rate system. Now, those high interest rates are, I think, an international phenomenon. I don't think we have any information for you today about whether we are receiving complaints about it, but we can come back to you on that.
But the report doesn't deal with this.
So again, it's very important. This culture report, we think it's important, but it's not a report on everything going on. Our daily supervision, our daily work, there's all sorts of issues all the time we're dealing with. It's really just one perspective about, in addition to us enforcing our rules and regulations, we're saying it would be better if these firms didn't create the problems in the first place. If they had an organisational culture that was more consumer focused, there'd be fewer headaches coming to us. So the intent of the report is not to have a checklist of here's all the problems we're facing and here's the solution. It's saying in addition to our daily work of checking that they're obeying the rules, we want to go beyond that by saying if you adopt these cultures, the risk to consumers would go down because these problems would not emerge with the same frequency.
Mr. Chairman. Okay, Senator Horkan.
Thanks, Céidigh, and thanks Governor Lane and Mr. Sibley and Ms. Rowland for your opening statement, and indeed for the 51-page report which I read in great detail, and we've touched on bits of it, but in fact there's an awful lot of it we haven't really got to yet, and I'm going to try and touch on aspects maybe that, even though we've been questioning for 2 hours, there's quite a lot of it that we haven't yet been able to get at. But I think it's important that I do just touch on the trackers, and it may not be for the culture report to do, but I think there is a body of work to be done to work out at some point how every bank managed to make almost identical tracker mistakes independently of each other, and that it's hard for an ordinary person with any level of common sense to wonder how there could have been at some level of semi-collusion or semi-discussion, or Ireland is a small place and people talk to, well, we're all tightening the rules and we're all putting a bit of pressure and everybody starts doing it in the same way that maybe everybody ran after Anglo-Irish Bank when they started performing in a particular way. Well, it's working for them, so let's all copy the model that history says shouldn't have worked. So I think there is a body of work to be done. I'm not saying it should have been done in the culture report, but the culture report is a result of the tracker problem.
So, I mean, I think this is exactly where we have these enforcement processes in the works, because that's going back over all the evidence. What do the files say? What do the email trails say? What do the minutes of committee meetings say? So this is exactly what's going on. And then in addition to interviewing key people and so on, so reconstructing what happened is really what the enforcement processes is doing.
So I don't want to prejudice any legal cases, but is it possible that we could see a situation where we find that the banks were talking to each other and we're all their profitability was absolutely in huge trouble. There was massive losses being created. They were looking at any way of trolling back or clamouring back some level of profitability or reducing the losses, and that they were talking to each other, because it just seems amazing to me that they could have all been done pretty much the same things independent of each other at the same time.
So let me not rule anything out, because we try to be evidence-based in these processes. But I mean, I've said this to you before, to this committee before, the counter narrative is essentially when they face the same common problem without any collusion, when they have the same cultures in the banks, the fact that they arrived at similar answers doesn't require collusion. It doesn't rule out collusion, but it doesn't require collusion.
But they were breaking rules, and they were breaking their own customers' contracts, and they were interpreting them in a way that they shouldn't have been interpreting them.
Well, again, the balance between all of those different elements, I think, is part of the enforcement campaign. And again, as we've emphasised, in this tracker examination, it's not just a question of looking rule by rule, it's the whole perspective about were they treating customers correctly.
Yeah, just the point, and I'd like to put it on record again, and I think I may have done it before, we've with individual banks, but this idea that the tracker mortgage cost the banks X, whether it be $1 billion or 580 million or whatever the figure is, a very substantial proportion of that, the bulk of that, is giving back money to people that they should never have had taken off them in the first place. Yeah. It's not really a cost. Okay, if they hadn't been caught, it would have been effectively extra profits that you should never have earned. But the idea that this is all a huge cost, there's obviously a compliance cost, a redress, there's an element of compensation, which is an additional cost. There's an element of administrative burden, which in some cases is quite significant. But a very significant proportion of that billion, you might clarify, is the giving back customers the money that should never have been taken off them.
Yeah, that's completely fair. Absolutely. So that's true. So if you like, you could... But
I think the narrative in your report, it does say it's cost the banks $1 billion. I don't think we should be talking in that way.
Okay, no, I think that's perfectly fair. And if I were to rewrite the report, I would make that point. That's fair. Mm-hmm. That's true.
Okay, yeah. Thank you. That really just parks that. But thank you for acknowledging that. I did read the report, and there's an emphasis. I mean, I suppose it's pointing out that however bad everything was, stuff is certainly better than it was, and I think that's blatantly obvious. It should be after 10 years since the guarantee, 8 years almost since the bailout. But there is still a tendency of firefighting, still a tendency of going back to the old ways. I saw a reference to board meetings being so full of regulation and so full of headed items that have to be informed. And I know this happens in other organisations. You're dealing with so much compliance that you just don't get any time to deal with long-term strategy. And you mentioned that. But is there a genuine issue in all of the 5 main banks with planning and looking at the long-term future of themselves and equally of the country? Because whether we like it or not, the country needs banks as much as banks need the country, or they need something instead of banks if they don't have banks. And the issue is, you know, I'm not convinced by your report that there's enough long-term strategic thinking going on at board level. And it's very easy not to do it, but it is essential.
So let me make 3 points. I mean, I'll turn to Ed in a minute on this, but I think at this point, I mean, obviously over the last decade, a lot of work was on resurrecting the capital positions of the banks, all of these things. But that's done. These are, I mean, there's some elements to do in terms of their balance sheet, but by and large, as I say, then the next conversation is what is the long-term strategy? And there's really 2 dimensions to that. One is the balance between long-term strategic decisions about, let's say, the role of IT or what business lines to be in, versus I mean, I think what we're saying in this report is, in addition to that, you need to have a long-term strategy in terms of how am I going to do right by the consumer. And there's not enough attention paid to consumers in those strategic discussions. But maybe Ed will have...
I think it's a very good question. So in terms of how banks are considering strategy, how they're thinking about the long-term future, and again, as you allude to, and part of the issue that comes out of the culture report is actually that them being able to move away from the kind of crisis mindset, circle the wagons mindset, to actually thinking about the longer term. We're very focused on making sure that they are thinking about the longer term, that they are not just thinking about the next 6 months and the next year. Typically, a strategy will be set for kind of 3 to 5 years. There are some real challenges in doing that, given the level of change that's in in the system, financial innovation, technology change, new competition and the like. So it's very difficult to look forward 3 or 5 years with any degree of confidence, but we're absolutely driving to make sure that they are thinking about that, both from a strategy perspective, but most importantly from a financial resources perspective, in terms of making sure that their funding is much more secure than it was, and can sustain their business over the long term, that they have sufficient capital to deal with the downside, a kind of plausible downside, so that they can deal if they do get into difficulty. And then if they do get into difficulty, they've got their own thoughts about how to recover, and we're very active in terms of resolution planning. And all that runs alongside the work that we think about from how are they interacting with their consumers, are they treating their customers in a sustainable way, and clearly there's more work to be done there. So it is absolutely a focus of our work. I think they are getting better, but I certainly wouldn't claim that they are completely where they need to be. And then there's the other incentivisation of analyst reports, quarterly earnings, and which brings a kind of a short-term focus to what is needed to be a kind of a long-term vision.
Okay, and just in terms of the long-term, short-term, obviously in the past, I think it's fair to say a lot of performance bonuses and incentives and rewards were based on the money that was lent out rather than the money that was got back. So you lent money all over the place to people. You lent, people bought fields in Wicklow and Meath and Kildare in the hope that they'd be rezoned, and we'd all kinds of things would happen. I know anecdotal stories of people who were given 35, 40 million and didn't even have to give any security for it. And then it was like, well, what's security? Well, if you don't know what security I needed, I don't know what security. This was stuff that was happening. And people were getting rewarded for lending money recklessly. Is that still possible? Or can it still happen? Or is it now a case that the reward is based on long-term performance of that loan as it's repaid?
So there's probably three aspects to answer that question. Firstly, in relation to those banks that have a degree of state ownership, so Bank of Ireland, AIB and PTSB, there's very firm restrictions in terms of variable pay that can be paid within them. So that's very tight. But I will come back to them in a second. Secondly, in terms of the overarching rules at a European and international level, a lot of work has been done to make sure that any variable pay element, there is potential clawback up to, indeed, in fact, 10 years. So in the circumstance that you describe, if someone is incentivised to do something that's profitable for the bank or the institution in the short term, but longer term has costs, then that variable element can be clawed back, and that's part of the regulation.
And the clawback mechanism is out of their pension if they're retired, or how does it work?
They would have to pay back whatever it was that was whatever is the variable element. But the third point I wanted to make is that incentivisation goes beyond simply bonuses, so it can be around. And we have seen one instance where there was a table on a wall around, well, who was top of the charts in terms of lending, through to who's going to get promoted. And so there are lots of incentives that are non-pay. We are absolutely making sure that, in terms of trying to understand how people are incentivised to behave within their institutions, is aligned with both the kind of long-term success of the institution, but also the sustainable treatment of their customers. And that's one of the reasons that we're very interested in the behaviour and culture of firms, because how you drive culture is how you incentivise people, and so it is very much to the forefront of our mind.
In terms of the report, there's a reference to over-optimism and kind of, look where we came from, aren't we fantastic? I would get the impression from the various banks that come in here, there's a certain lack of humility as to, okay, some of the management teams are different and there's new people there, and I suppose they have to try and sell themselves as best they can. But I don't get the impression that they realise just how bad, people were hit by it individually. We have all the cases coming into us, and various individual members have really traumatic stories, including, not just people losing their homes, but people losing their lives, and people taking their own lives because of what happened to them during the crash. Some of it partially, at least, a result of the pressure that was from the banks of phone calls 6, 10, 8 times a day, whatever it was. I don't get the impression that the banks, even through all the culture reports and all, there's a humility there that really should be there based on how much they cost. And okay, we haven't had Anglo in here, but every bank was culpable to a greater or lesser extent. The over-optimism thing, I would be very concerned about. Can you maybe just outline a little bit more about that?
So I think it's important to emphasise is some of the remedies to tackle that are building a culture of internal challenge, so the ability to speak up and speak out, and also there's a very important role for the board here, because especially the non-executive members of a board have that duty to hold, the executives to account. So in addition to what we can do as a regulator, the first line, if you like, of managing that risk of over-optimism is having independent directors who are prepared to be independent. And that's part of how we review when we do the fitness and probity for those who are going on to bank boards. And that's an arduous process now. It's a significant process, which has the SSM component for the banks under the SSM. And then in terms of internal dynamics in the committees they have and so on, that the ability to speak out against any kind of overarching culture is very important. But
maybe just to supplement, one thing I wouldn't want completely lost is that not all the banks are at the same stage. This is an aggregate report. It does mention it in the report. There are banks that, and I know that the committee might have a degree of scepticism to this, but there are banks that have accepted earlier the need for change and are probably further along.
It does reference on the report. It does say that there's
in that change. But this is also one of the reasons that we are so interested in diversity, because you're right in terms of the people that you'll have and you've had in front of you from the banks. They look very similar to the people that you've had here in the past, and they have very similar backgrounds. That over-optimism point and that resistance to challenge point, there is aspects of that relate to the lack of diversity in the institutions at very senior levels, and particularly at the levels that are and in the roles that are responsible for driving the business forward. And so that's what we've been pushing for: a greater diversity across financial services over the last two or 3 years. And again, we can start to see some element of change coming through that, but again, it's at relatively early stages.
Well, it was actually, I've written it down, it was my next point, diversity and inclusion. What level of diversity? Because we are here over 2 hours, it's quite a big chapter in the report and nobody mentioned it. You would expect in a bank to have quite a number of, okay, I declare I happen to be an accountant, but you'd expect to be lots of bankers and accountants. And obviously gender balance, some of the figures they make Leinster House look good in terms of female participation, in terms of what the figures are. In terms even of applicants, I think it's down to 10 and 12% at one stage. I think it's up to maybe 29 now over 5 or 6 years. But that doesn't necessarily indicate that they were successful. It's just the applicants in some cases. Obviously, there's gender diversity required. But what other diversity are you really talking about?
Okay. Well, let me mention, and then I'll turn to Ed again, one is geographic. It's a small country. I think
less than everybody else.
The observation from not just here, but also from the Iceland crisis and the crisis in some of the smaller countries in Eastern Europe is having the insularity of, it's a small country. The fact that these executives and board members are drawn from a fairly small pool, the risk of groupthink there, the risk of being afraid to confront. So a basic element, which for a small country is quite possible to achieve, is having outside voices. People who are not connected to the Irish system, who have no reason to be particularly bashful in speaking out. So I think that's an obvious element, and there's a degree of that in the boards of the banks. So I would highlight that, but Ed can maybe...
So, to support that, when we talk about and think about diversity, we think about it in its broadest forms. So, both in terms of what you can see, and also in terms of what you can't, and also in terms of experience and capability as well. And we're very much focused on thinking about this as in a construct way. So. How does the board work as a whole? How does the executive team work as a whole, and not just kind of the individual capabilities within? It's gender's more easier to measure than most other aspects, and there is an acute gender diversity issue. And you can see that in the report. You can see it in the statistics we published over the last couple of years around those applicants for the most senior positions. But it's even more acute when you look at the roles that people are taking up. So at entry level, at kind of middle management level, kind of 50-50, 60-40. So it's a relatively balanced. But as you get up the organisations, then you get very acute gender diversity imbalances. And if we look at the roles that are really driving the businesses forward, so the CEOs, the CFOs, the chief execs, the chief finance officers, the chief operating officers, and the heads of retail and the like, then it's about 94% of those are male, often coming from similar backgrounds and similar experiences. So we then get into real risks around groupthink, the over-optimism, kind of lack of challenge, a resistance to external challenge, that kind of circling the wagons thing. So I mean, again, this is on top of all that we do in terms of the regulation and supervision, but to my mind, it is a kind of leading indicator where we see that lack of diversity of cultural issues and poor potential outcomes, both from a prudential and from a consumer perspective.
Okay, on a related and final matter, it's related to culture and to the diversity. Just the whole matter of the government looking at the banks wanting the cap on senior pay being released. Most people would argue 500,000 is a lot. Obviously, these people think it's not enough, and that they're losing staff in the mid-teen percentages, I think was referenced in AIB. What are your thoughts on the cap on salary? I think, Ed, you might have referred to it earlier that you were going to come back on just the banks that are state-owned versus are have a portion of state ownership versus not. Just this whole idea of caps on salaries and bonus pay generally. Thanks.
So, I mean, first and foremost, I do think that's a matter for the Oireachtas to determine as part of the legislative framework. And I think within that there are certain choices to be made. So that the banks that are under state ownership are run as commercial enterprises. That's how the country's decided that is best and that will deliver the best outcome for the taxpayer. And obviously that's subject to some discussion, perhaps. It is true that in some of these senior level roles, so the roles I've just described, people can earn more money in institutions, whether they be banks or non-banks, doing similar roles elsewhere. So if it's purely a pay dynamic in terms of people whether they choose to stay in or go into a role, then by having lower pay thresholds will reduce the pool that can be either kept or recruited. Now, the impact that then has in terms of ultimately the return the taxpayer gets, I think, is a choice for the Oireachtas. What we would be most focused on is making sure that the incentivisation lines up with making sure that the institution is run in a safe and sound way, and run in a way that respects and
just the final question: are you suggesting that if the cap isn't removed, that you'll end up with less good staff and the performance isn't as good? Is that the suggestion?
So I certainly not. I'm not. All I'm saying is just factually, it is the case that someone as a chief exec or a chief finance officer or a chief operating officer, heads of retail, can earn more than that cap, and in some cases a significant multiple of it. I'm not making any judgment as to whether that's right or wrong. It's just a matter of factual reality. What we're very much focused on, and the legislation is focused on, the rules are focused on, is making sure the incentivisation attempts to line up with the long-term good of the institution and its customers.
Thanks, Chairman.
Thanks, Senator. I propose to suspend the meeting now until about 1:15, if that suits everyone concerned.
Thank you.
We have a vote at 1:45 and we'll resume at 1:15. Thank you very much. Ask Governor Lane to make her opening remarks, please.
Thank you. So in this Part B, let me cover three topics. One is the macroeconomic cycle, two is non-performing loans, and three is Brexit. And in terms of how we think about where we are now, the kind of one-line summary is that during economic upswings, as we're currently experiencing, it is vital to build up financial and fiscal buffers. If we want to have easing policies during downturns, that requires corresponding restraint during expansion phases. So in terms of the macroeconomic cycle, we're currently in a phase of strong performance, where we're seeing a broad-based expansion in employment and an increase in earnings. When we look at the labour market, the momentum is towards full employment, although, as always, extra employment is possible if policies can lead to broader participation in the labour market. And let me emphasise is that what we're seeing now is not being fuelled by imbalances in domestic credit or external imbalances. So the unsustainability that we saw a dozen years ago is not in evidence at the moment. Now, having said that there's a strong momentum in the economy, we also can clearly see, as can everyone else, clear downside risks. One is a generic vulnerability, which is where we are now is we've an accumulated stock of high public debt, high private debt, and we have to recognise, as a small open economy, we're especially vulnerable to international shocks. Now, what might be those international shocks? One is an unexpected tightening in international financial conditions, which would be in contrast to the easy monetary conditions we've seen for the last long number of years. And if this happened, you could see a shift in the world economy in terms of a slowdown in world demand for investment and consumption. Two external shocks or risks which are clearly especially relevant for Ireland are any change in the international trading system or the international tax regimes might be particularly relevant for us, while of course a disorderly Brexit would pose immediate challenges for the Irish economy and the Irish financial system. As I indicated in my pre-budget letter to the Minister, the fact that we have these clear downside risks calls for the accumulation of financial and fiscal buffers now that would help to limit the damage if any of those risks materialised. Let me emphasise in relation to the financial sector, we have taken steps recently to further reinforce the capital positions of banks. In particular, we announced the activation of the counter-cyclical capital buffer, which will require banks to maintain an extra buffer in relation to Irish exposures. So what this means is that if we have a restraint now in terms of extra capital accumulation by the banks, in a future downturn, this buffer can be released, which would help to avoid a damaging credit squeeze in the future. So I think that's an important policy which is new, which we turned on this summer. And in parallel, in relation to fiscal, we do think that running budget surpluses during strong periods is a precondition if the government wants the flexibility to implement a stabilising counter-cyclical fiscal expansion in the event of a further downturn, so to avoid austerity piling on top of a downturn in the future. In terms of the housing market, we share the consensus that a substantial expansion in supply is required if the high demand to own and rent homes is to be satisfied. The limited supply of housing has contributed to the increase in rents and house prices, in addition to positive demand factors such as rising employment, increasing earnings and supportive monetary conditions. Our mortgage rules, which place ceilings on loan-to-value and loan-to-income ratios, has helped to limit the amplification of pricing pressures by limiting the credit dynamics. And in particular, again, in terms of preparing for a future downturn, if we avoid over-lending by banks and over-borrowing by households at the moment, that will make the next downturn easier to absorb. Now, with the mortgage measures, we are committed to an annual cycle of review. This year's review will be announced in late November, in line with the normal schedule. Now, if I turn to non-performing loans, 10 years from the crisis, 5 years from the peak, it remains the case that non-performing loans are a cause of considerable distress to those affected in terms of borrowers, and also are a source of vulnerability for the banking system. And again, remain on the general theme of preparing for the next downturn. It is a risk both to the lender and to the debtor if these are not dealt with. And so we really do find it a priority to reduce the non-performing loans, but in a sustainable way that provides strong protections for borrowers. That is a clear priority for us. It's important to say a lot has been done in terms of progress, both in terms of what we've done and other parts of the state infrastructure in managing this problem while maintaining consumer protection. The Code of Conduct on Mortgage Arrears has played a critical role. By end of June of this year, in terms of a timeline, more than 116,000 primary dwelling house mortgages have been restructured. So a lot of restructuring has happened, with 87% of those maintaining those restructured agreements. And we have seen the progress in terms of the numbers of arrears cases falling now for nearly 5 years in terms of 19 consecutive quarters. And we've seen the number of long-term cases also declining for the last 3 years. Now, it remains the case this issue of long-term arrears remains a source of concern. About 42%, which means around 28,000 of the 66,000 primary dwelling house accounts remaining in arrears are in this long-term category of basically more than 2 years past due. Now, no matter how late it is, we do emphasise that engagement by borrowers is critical in order to avail of the safeguards provided through the CCMA and the mortgage arrears resolution process. Now, again, an important element in managing this problem is to recognise that a secured lending market, which is the foundation of mortgages, needs to allow for repossession as a possible option. So, notwithstanding the extensive use of forbearance and restructuring, there will be cases where alternative choices are needed. I think one element of what we're seeing is the sale of non-performing loan portfolios by banks. This does lead to a reduction in the size of bank balance sheets, and through the sale of the non-performing loans, it does reduce banking sector risk in the event of a future downturn. So it is the case in terms of a national risk assessment that the transfer of credit risk and funding risk to investment funds that are the buyers of these portfolios does constitute a national reduction in macrofinancial risk, especially given that investors in these funds are primarily overseas. So, if you like, I know there's a lot of concern, and we can talk about the concerns about these loan sales, but the underlying rationale, there is a potential gain here in terms of national risk exposures. And this is especially the case given that we do have statutory consumer safeguards in place. In terms of how we do our business, we treat equally the dual mission of safeguarding stability and protecting consumers. So we're absolutely committed to ensuring that the consumer protection framework continues to cover loans that are sold. And in terms of the existing legislation that the Oireachtas put through, it is the case that the loan owners must use a regulated credit servicing firm to manage these loans, and these firms are subject to the same codes of conduct as banks and retail credit firms, including the Code of Conduct on Mortgage Arrears. So this provides the same consumer protection framework regardless of whether a loan is sold or not. And this is a legal requirement. It requires that arrangements are appropriate and sustainable for borrowers based on a full assessment of individual circumstances. And regulated entities must make every reasonable effort under the CCMA to agree an arrangement and only use repossession as a last resort. Now, as a request by the Minister for Finance, we are currently reviewing the CCMA to ensure it remains appropriate, especially in the context of loan sales. And we will be sending this report to the Minister later this year. Finally, it's important to note also that, of course, our contribution is only one part of the wider state framework in terms of consumer protection and debt resolution. There are other services and supports available, including the National Mortgage Arrears Resolution Service, OWALIA, the Insolvency Service of Ireland, and schemes such as Mortgage to Rent. Let me turn to Brexit, which clearly will be, compared to UK remaining in the EU, will be a negative for the Irish economy and the Irish financial system. So at one level, we are closely monitoring the financial stability risks, which of course are most at issue in the case of a hard Brexit with no deal and no transition period. And we're working with our European partners to mitigate these risks and ensure that the firms we supervise are suitably prepared. Again, we are focusing on the worst case scenario to make sure that even in a disorderly Brexit, the preparations are made. What's been happening is a consistent and coordinated approach across the EU, where, as part of the single supervisory mechanism, the Eurosystem, and through the European supervisory authorities, we are taking a shared approach to mitigate these risks. And there's been a lot of work done to communicate supervisory expectations to firms to make sure that they are preparing for Brexit. And some of the issues at hand include booking models, internal governance, risk management, and the design of internal models. We emphasise that the lead responsibility is on the firms, whether a firm that's already present in the EU 27 or a firm that needs to set up an entity post-Brexit. Especially in all of this, firms cannot rely on a transition period which is not guaranteed, and we are again tasking the firms to prepare for the worst case scenarios. Now, we don't think the firms are alone in this. We, as a regulator and the regulatory system, have a responsibility to take necessary mitigating actions in a timely fashion. And no matter what, though, I mean, this is all about what might happen with the exit and transition, but the longer-term issue is, no matter what, even under the softest Brexit, the UK and EU 27 will be separate financial systems. So compared to what we have now, this is a major change. And one manifestation of that is we have more than 100 applications for authorisation here as a result of this, across a number of sectors. This is partly new legal entities and partly existing entities who need to extend and expand their current authorisation. Some of these firms are looking to sell to Irish customers. Others are looking to use Ireland as a base to sell to the EU 27. These are banks, investment firms, trading venues, electronic money institutions, commercial insurance and retail insurance. And the approach we've taken from word go is to deliver our gatekeeper and supervisory role in a proactive, predictable, transparent and consistent way. Now, while of course there's much discussion about the relative attractiveness of Ireland compared to other locations, our goal is clear, our role in this is clear, is to maintain financial stability through assertive risk-based supervision. And in so doing, we're engaging effectively with our colleagues across the European ecosystem of regulation to make sure that there's no risk of regulatory arbitrage in this dynamic. So let me summarise by saying it's clear we have a number of objectives looking towards 2019 and beyond. One major focus is this topic of resilience, that during these relatively good economic times we need to build the resilience of the financial system to prepare for future downturns. We also are seeking to mitigate the risks we can see in relation to Brexit, whether they are the economic risks, the risks to the financial system and to consumers. And maintaining our discussion from this morning, a high priority is to strengthen our approach even more to financial conduct regulation in order to protect consumers and investors from a systemic perspective. So let me stop there.
Can I just clarify something,
please,
Governor Lane, in relation to what you say about the sale of the loans to essentially vulture funds? Who established the figure of 5% for the banks to reduce their bad debts to 5%? Who did that?
Let me turn to Ed.
So there is no target. There isn't a 5% target. Where that 5% has come from is at a point in time it was broadly speaking the Eurozone average for non-performing loans, and there's been a drive from a supervisory perspective to bring down non-performing loans for a variety of reasons that the Governor has touched on, but there is no hard target. The 5% is reference to the Eurozone average. At that time, it's now about 3.5%.
So it's a general political view from Europe that we should try and stick to the average of 5%.
Well, no, so, I mean,
without stating it.
I mean, the nature of non-performing loans across the Eurozone is that they are high in some jurisdictions and some institutions, and typically quite low in other institutions and other jurisdictions. So the use of an average is actually is not very helpful, because you have kind of very low numbers and quite high numbers. So there isn't a push or a target. So it's a reference point to talk about, well, actually we should be striving to reduce non-performing loans, because they do cause distress for borrowers, they are problematic from a resilience perspective, and they cause issues from the functioning of the system. So, but there isn't a 5% target.
Right, so the point is, there's no 5% target as a directive from the SSM,
no.
And the central bank here has no target of 5%. It's an average that was across Europe at one point in time. That's fine, you've clarified that. Can you now tell us, in relation to non-performing loans, where a bank has warehoused part of the loan, the definition for a non-performing loan and what you might expect the banks to sell? And I'm talking about the recent experience with PTSB and others.
So it is absolutely possible for restructures mortgages with a warehouse element to what we would describe as cure, so that they would become performing. We've had a lot of engagement with our colleagues in the ECB and across the SSM around being very clear as to what's required, because similar products or similar approaches to restructuring are used in other parts of the Eurozone. And the requirement, slightly simplistically, but the key requirement is that the warehouse bit is fully provided for. That has been the practice in some banks operating in Ireland, but not in others.
What would you say to banks that are using the excuse of a warehouse part of the loan being reason to deem it non-performing and then to sell it on to a vulture fund?
So I would say that the loan can cure without having to sell it. The loan can be cured, and that's a decision around the.
And is there anything that you can do with the banks that are selling on these loans that are part warehoused? Is there anything that the central bank can do to make your view known?
So
that they can't say that these are non-performing loans because they are in fact a solution within the bank.
So again, I'm treading somewhat carefully, because this is really focused on one particular institution.
No, all of them. They're all at it.
Well,
in one shape or form.
Well, sorry, there have been sales, but the particular example that you give, I think, is in reference to one particular institution. As part of our engagement with all firms, we're making sure that they are addressing the levels of non-performing loans that they have in a way that's sustainable, in a way that respects the need to address the problem, but also protect their consumers. It is really important that, and we've raised this before, that regardless of the ownership of the loan, the customers remain protected under the CCMA. We are making sure that any decision that's taken in relation to loans does factor in very sharp consideration of the end consumer.
Right. Deputy McGrath, is it?
Thanks very much, Chair. Just if I may start, Governor, on the question of competition in the mortgage market here and our ability to attract new entrants and the role that the central bank's capital requirements play in that regard. So can you just clarify for me in relation to the rules that would apply? And I'm just wondering if there is any deterrent for lenders coming in because of the capital requirements that they would need to put in place. So the risk weighting for a mortgage in Ireland by way of capital has to be put aside. What is it here? So if a bank comes in and offers mortgages,
sure,
what level of capital has to be put aside?
So I'll turn the detail to Ed in a second, but maybe the first point to make there is a level playing field. It's not the case. So in other words, it's not. Sometimes we think of a barrier to competition that a new entrant will be treated differently to the existing.
Yeah.
So that's not the question here.
Yeah, but still a factor.
Yeah. But let me turn to Ed about how we think about risk rates.
So there's, if you forgive me, there's a degree of complexity to the answer. But I mean, the core point really is that the risk weights, the amount of capital that a bank needs to hold here in order to, relative to its mortgage book, reflects the risk. I mean, that's the core principle. There is some of the banks here operate on what is termed a standardised approach, which has a kind of defined risk weighting for everyone. So everyone uses that approach, and whatever jurisdiction you're in for residential mortgage lending, that's a standardised approach that you would use. The larger institutions would typically use their own internal models, and that's based on the performance of the book over a period of time. And typically, in most instances, in most jurisdictions, those risk weights through using the internal models would be lower than the standardised approach. But because of the history of in Ireland, with the level of loan losses experienced, the level of non-performing loans that remain in the system, the losses associated with those non-performing loans, there isn't that much difference between the standardised and the internal models. Now, to just build out a little bit on the Governor's point, what we would expect is exactly the same as what would be expected across the entire Eurozone. So there's been a big programme of work in terms of, which is called a targeted review of internal models, to make sure that banks across the Eurozone are following similar approaches, similar methodology and similar outcomes in terms of calculating the amount of risk weight relative to the loan book. But it is absolutely the case that risk weights in Ireland are higher than many, not all, but many other jurisdictions.
Maybe, I think this runs across a lot of the debate. Why is it the case 10 years later or 12 years later these risks are deemed to be so high? So one element is basically, I think time needs to pass in order for Ireland to demonstrate it will maintain the stability to avoid the boom-bust cycle we saw before. So we think it's not going to be like that before. There's a lot of policies now to avoid what we saw in 06-07. But in terms of the legacy of history, that is there. And then the second element is what's called loss given default. If you do have a default, how much can you recover? And the fact that here the ability to repossess homes and so on, and that's, there's a perfectly legitimate choice made here to have a lot of forbearance, a lot of avoidance of repossession. But from a kind of an external bank looking at Ireland, that is a clear factor they look at, saying it's very difficult to recover collateral in this situation.
Sure. I'm looking at a table here from the EBA, which shows the average internal risk-based risk weighting for residential mortgages, H1 in 2017. It shows Ireland 42.5%. Sweden will be at the other end, 4.2%. The UK, 10.5%. So I suppose my question really is whether it is appropriate to levy those very high risk weightings to mortgages that are being issued now in an entirely different environment and under a different rule book, whereby you have the macroprudential rules, the 80% typically, the 3.5 times loan to income. Is such a high risk weighting shaped by history and our experience during the crisis and the fallout from the crisis? So what I'm trying to get to is this an issue and a deterrent for foreign lenders coming into the Irish market when they look at the risk weighting that they are required?
But let me emphasise, this is not coming from us. This is the assessment of the analytics, saying if you look with a cold analyst's eye at the risks in the Irish market. I mean, I agree with you on we think the system is structurally different now, but the issue about the recovery in a default situation, the long delays and so on in restructuring a mortgage, that remains an issue. But let me turn to...
Yeah, but just before you come in, I mean, like that risk weighting has been shaped by a history of 100% mortgages, 6 times income being given out by way of a loan, and now it's fundamentally different, and yet we still are attaching a very high risk weighting to new mortgages under entirely different rules. And it just seems to me that that's a real issue as we're trying to get more competition into the Irish market.
So, I mean, I referred to this earlier. It's absolutely our desire to have a functioning financial services system that serves the needs of the economy. That includes a functioning secured lending market. And part of that is to continue to address some of the dysfunction, and we might get into that if you so desire, that we see. But in terms of what the banks themselves are calculating under the rules of the Capital Requirements Directive and Capital Requirements Regulations, from an internal model perspective, that is still the number you quoted there is still based on their entire book. So it would reflect both elements of the new lending, but still, because new lending has been relatively muted relative to the whole books the banks have here, then it's going to reflect the risk profile of their entire book. I haven't got that precise graph in front of me. Maybe I'll picture up wrong.
Yeah.
But certainly, in terms of the risk weights that banks are being required to hold here today, it will reflect the risk profile of the entire book, both new and back.
Of that bank.
Of that institution. Now, a new entrant would have the opportunity to look at the risk profile of the lending that they were doing, and if they were at a more advanced end, sizable end, then they would have to model that themselves based on the profile of the mortgage lending that they were doing, comparative history, because they won't have their own experience, and come up with an appropriate risk weight using the methodologies that are standardised, standard across Europe. But they would be looking, in making those calculations, they would be looking at the dynamics and the functioning of the Irish mortgage market here, and given the levels of default that were here historically, recognising that was the past, and the level of the level of risk within the country, I would imagine that they would form the view that the risk profile of lending into Ireland today is different from lending, say, the likes of Germany. Now, whether it's by the factor that's in the current risk weight calculations is
okay. I'll move on. In relation to Brexit, in the event of a cliff edge Brexit and no transition period and no deal, how prepared will we be in relation to financial services, products being sold into Ireland on the basis of the passporting provisions, the branch operations, and obviously it works the other way as well. Companies that have their prudential regulation here and are selling into the UK market, but from the point of view of Irish consumers buying insurance products and so on from very big firms, to what extent are they all going to be ready in the event of there being no deal at the end of March?
So we've been really focused on this. I mean, as the Governor's referred to in his opening remarks, we've been very focused on Brexit for a number of years, thinking about the macro risks and also the particular risk that you identify, and that's the continuation of the provision of services to consumers in Ireland. And to use the example that you've referred to in insurance, there are lots of providers of insurance into Ireland from the UK and to a lesser extent, but still relevant from Gibraltar. We've made sure that we, to the greatest extent possible, understand the volume of those contracts and policies that are provided from the UK and Gibraltar, and made sure that we have got, to the greatest extent possible, a good understanding of the contingency plans that are being in place and invoked to address the issue of the provision of service after Brexit. For the big firms that are passported in and are providing kind of ongoing service in Ireland, we'd be very confident that they have contingency plans, that they're implementing those plans and they're addressing them. But the volume is such that at the very tail there is a possibilities that we won't get to 100%. Maybe it's 99% we get to, in which case there is some risk there around a hard Brexit.
Two other questions, if I may, Chair. Just on housing, Governor, you have welcomed the moderation in house price growth, and you made some comments the last time you were before this committee as well. What's your own assessment now of the housing market and house prices, and is supply coming on stream at the pace you thought it would? And does the Central Bank see further moderation in growth, or perhaps an end to growth in prices, or what are you looking at over the period ahead?
Yeah, we on these investment, the construction activity, it's grown. There's been a significant growth this year compared to last year, and the pipeline between now and next year and between 19 and 20 we see as quite significant. So definitely, whether you're looking at completions of new homes, but in addition to that, by the way, there's other elements such as home renovations. You know, there's another part of residential investment in terms of improving homes and so on. All of that is showing strong growth year by year. But I think, so in other words, there is a supply response happening, but it's still below, given the many years of underinvestment, it's not closing the gap completely. So this remains a multi-year, the reality it's a multi-year challenge. And it also remains the case there's many public policy issues about affordability, social housing, all of these things, which is in the hands of the Oireachtas. As you know, under the we have a budget next week, and under public investment programmes and so on, there are choices to be made. But on our current projections, it is the case there's a significant pick-up this year compared to last year, and we see it continuing to expand year on year. So it's definitely moving. So the situation is different now than it was 2 years ago, but it's not enough to close the gap. That is true.
And on prices?
Prices, it's a contest. On one level, the economy is growing. There's more people in employment, and wages are starting to pick up, and in some sectors picking up quite a bit. Now, that probably affects some districts more than others, but there is momentum behind that. And we do think our rules are biting. So there is a clear, at least in Dublin, there's a clear effect. But let me emphasise is there's still plenty of non-mortgage transactions going on, especially in lower price segments. So the price growth is disproportionately out of Dublin because there's more room for expansion in maybe some of the lower priced regions of the country. So you know, there's one experience in Dublin which is kind of hitting the limits. But that's not true across the whole country. That's
okay,
for sure.
Finally, Chair, one of your Deputy Governors, Sharon Donnery, has applied for the chair of the SSM board. We were out there recently as a committee in Frankfurt, met the current chair, and we wish the Deputy Governor all the best in that application. I think you have confirmed publicly you are interested in the Chief Economist position in the ECB, which will become available next year. So from the point of view of corporate memory, top jobs within our own central bank, there is the possibility of 2 of the top 3 people moving on within a period of months. We may not get both, looking at it from an Irish Inc. point of view, but have you any observations, comments to make on that, about the need for continuity, retention of experience, knowledge, and so on?
Absolutely. So, I mean, from word go, from the time I joined the bank, the whole ambition here, and the only way the bank can be sustainable is if it's basically a machine. So whether it's me or Sharon or the people beside me, We have to operate on the basis everyone is replaceable. You can't count on it. So what you need is a pipeline. So in terms of having a pipeline of people who can step forward. So a lot of the effort we do in the bank is to cultivate and build the next wave. So regardless, I think, of any individual, it is the case that the remarkable set of talented people in the bank, you get to see maybe the most visible layer is the people in front of you, but in terms of the talent in the bank, absolutely, we're operating as a team, as a machine, so the individuals should not be so important as the team.
Thank you.
Yeah, a couple of questions, and I just want to revisit the issue, if I may, in relation to Brexit. And the last time you were here, I think we can all say it's definitely more likely than when you were here before that we could see not only a hard Brexit, but Britain crashing out of the European Union with a no-deal scenario. In a no-deal scenario, that could mean no transition period. It could mean all bets are off in about 6 months' time. And can I just clarify, Mr. Sibley, in relation to your comments in terms of preparedness, is those figures in relation to that context, or in the context that we would be prepared, we would have 99% of institutions would have contingency arrangements, and there wouldn't be a disruption for either insurance holders or indeed any other who are availing of financial institutions that are located or headquartered in Britain?
So I mean, to be completely clear, in the scenario that you described there, which is unfortunately plausible, it will be rocky. So there is a high degree of interconnectedness between the Irish economy and the UK economy. So from an economic perspective, it will be very challenging. You'd be, I'm sure, very well aware of that. From a financial services perspective, there's a high level of interconnectedness in a number of ways, and there is, in addition to that interconnectedness, that the UK and London in particular is such a provider of financial services capability and flow into the rest of the EU. And in the event that there is a hard Brexit or a chaotic Brexit, that will be disruptive. It will be disruptive economically, and will be disruptive from a financial services perspective. What we're very focused on in terms of our work between now and the end of March is to make sure that we've got a really good handle on those cliff edge risks, that we're driving the firms to mitigate them as much as we can. We're mitigating them ourselves as much as we can, but there is it's plausible that there will be something of a gap between where we can get to and where we would like to be in terms of fully mitigating the risk. So if I use the example of insurance, so from what would be a freedom of services perspective, UK firms can, the example I've used elsewhere is where you kind of get rental insurance protection for car rentals. So kind of one-off policies that have been written, but that isn't necessarily part of an ongoing relationship between a policyholder and those kind of at the very tail. That there may be potential issues there that we are very much focused on closing down as much as we can. But in the nature of the scenario you describe, I don't think we can give 100% assurance that there won't be some rockiness associated with it.
My sense is the whole European system of regulators and lawmakers and so on can do a lot to manage those kind of risks. But I mean, I think that the major focus will not so much on that. It's going to be the financial market speculation. That what we're going to see is probably swings in the exchange rate, sterling euro, possibly swings in UK interest rates, changes in equity markets, and so on. So the financial volatility, if in the coming weeks the probability of a hard Brexit goes up, that could be in itself damaging, even if it ends up to being okay at the end of March. So I think the next, unless there's very rapid and very clear progress within this month and within November, if it's not evident by then we will be witnessing this volatility until the final answer is there.
Okay. And obviously all of us want to ensure that doesn't happen. In relation to what we can control or manage in that scenario, but going back to the issue of, for example, insurance, if the central bank has sight, for example, of companies that are using freedom of service rules, which are located in Britain, and can sell products into Ireland, and you have a good sense that they may not meet the end of March deadline in terms of, or that there's a risk that service could be disrupted. Is there an onus on yourselves as a central bank, particularly in relation to your role as consumer protection, to notify individuals in relation to that? I'm thinking of, it's not a liquidation process, but it's if somebody could go and be taken out in a product, for example, in February, thinking that there might be one of the 99 companies that will be okay, but there actually could be one of the 1% that don't have the necessary contingency plan in place at that time, and the role of the central bank. And I understand maybe the difficulty that the central bank could be under in relation to this as well, but how do we deal with that scenario?
So I mean, it's important to state that we're not doing this on our own. So we're very heavily engaged with our colleagues in the UK and through the insurance, in this case, a European Supervisory Authority, EIOPA, to make sure that there is a very clear handle on who's writing business where. And this, as you, I think, referred to, or maybe Deputy McGrath referred to, there is also an outward question as well, which we're also working on. We're making sure, to the best that we can, to close out this issue. It will all possibly, and similar to other non-financial areas, may result in a kind of reduction in the levels of supply in certain areas. It's very difficult for us to say specifically to policyholders as of today what we would require them to do in the circumstance that their contingency plans are being implemented, but we will keep that very much under review. The focus we've had to date is very much driving the firms to address it, to communicate with the brokers that are selling these products, to make sure that they are making sure that they can fulfil the policy for the duration of it. But there is some tail risk, which is basically what I'm talking about, which we keep very much under review, and how we're engaging on that with the firms, and as well in terms of our engaging with consumers.
Governor Lane, has the central bank updated or reviewed or currently reviewing its forecast in relation to that type of scenario, the no-deal Brexit scenario, where Britain crashes out of the European Union come next March? The impact in terms of jobs, the impact in terms of economic growth? So
we have a quarterly bulletin coming out sometime soon where we're going to have a dedicated study. Now, it's not quite finalised yet, but in general terms, this goes back to the financial market turmoil issue, is the way the models work is it's clearly negative for the UK. It's clearly negative for us for two reasons. One is, if the UK slows down, we lose export customers. But on top of that, all of the models say sterling is going to depreciate quite a bit. So there's a double hit here from the reduced export customer base and sterling moving. So there's no doubt it's a negative. But actually, my view is the models understate the negativity because they're not taking into account the financial speculation. Will there be a kind of a plunge in the stock markets? Will there be a kind of increasing risk premia in the bond markets and so on? So we will be reporting, here's what the models say, and it is negative. but actually I think it understates.
Because the model doesn't capture that volatility and that speculation.
It's an add-on, so
Okay.
that's it.
Okay. Can I ask you in relation to non-performing loans and the sale to the vulture funds? And we've been inundated with individuals, phoning us up or emailing us and saying, "Look, I'm not in arrears, yet this bank has turned its back on me and my family," and others who had a small amount of arrears have also been sold. Now, when we query this with Perm TSB, for example, they tell us in broad terms, they basically say that the definition of a NPL, while complex, is defined as if you were in arrears at any point of your loan, even if you are making full payments as was agreed in the original application with no arrears, you're defined as a non-performing loan. Now, we've teased this out with the committee, and maybe with banks in the past, and maybe I've missed something, but I've never understood a non-performing loan to be defined in that case, which would be, for example, me or you or anybody missing a number of payments in our mortgages 10 years ago, and having arrears of €1,000 and having them cleared 9 years ago, and it's still deemed as non-performing. Is that the case?
So let me turn to Ed.
So, as you described it, there is some degree of complexity, but ultimately, if the situation you describe in complete isolation of anything else, that if a borrower was in arrears and then cleared the arrears and was repaying the loan as originally taken out, there would be a period of time where they have to demonstrate that they can sustainably repay over a period of time. Typically, that's kind of a year, and that loan.
1 year, is it?
Probation period is typically a year. That loan would then return to performing. But that's if you look at it in complete isolation. There are other circumstances where possibly it wouldn't. For instance, if the borrower has another loan with the institution, and so there's a connection with another loan that isn't that is in arrears or is non-performing for some reason. So in complete isolation, one loan, one borrower, the circumstances you described, that loan should cure to performing, but it may well be the case that there is another loan or another reason for it to remain non-performing.
Okay. And that's the definition that's used across all of the banks. So
yes, there's a standardised definition that's standard is written by the European Banking Authority, the EBA.
So when we're looking at the percentage of non-performing loans, actually a number of these loans could be meeting their original contract agreements and could have been meeting them for about 9 months, and they'd be still deemed as non-performing.
Yeah, so those loans wouldn't. I mean, I appreciate there is a degree of confusion here because we talk about arrears and we also talk about non-performing loans. So you could have a loan that's not in arrears but is still classified as non-performing. That could be a timing question, so it could be returned, say, for 9 months and it be going through a probationary period, or it could be connected to another loan. And I've seen that where they have a loan that's performing well, that it's meeting the terms, but they've also got a connected loan, which there's a pulling factor associated.
We talked about the culture of the banks earlier on, and how you can change the culture of the banks, and is this for me and for a lot of people out there, this sums up to them the culture of the banks, particularly people who have made genuine efforts, who may have been in arrears, who have caught up on those arrears, are probably caught in that loophole where it was 6 months ago or whatever and is deemed non-performing, and the bank just tosses them over to a vulture. Is that not, can you not see the fairness here in terms of we talk about what do the customers want? Your report talks about that the banks need to look at what do the customers need, as opposed to looking at the objective of the bank and then doing a customer impact analysis afterwards. But surely to God, what's happening at the minute is the best example that the culture of the banks is as bad as it was. And I'm specifically separating out, while I disagree with the sale to vultures of any of these loans, what I'm carving out here is those individuals who are no longer in arrears and who are having their loans sold to Start Mortgages or other firms.
So you gave one particular example. My bet is that particular example, because with the 1 year window back to performing is maybe quite small, but there's a bigger group which is restructured loans. So in other words, they've come to some arrangement with the bank, so they may have arrears capitalised, they may have a split mortgage, they may be an interest only. There's a whole category there where it's not the original terms of the loan, but they have met some kind of
restructured agreement.
Restructured. And this goes to the issue, which is it's not unique to here, but in general, the fact that banks may choose to sell loans, whether they're wholly performing, non-performing, and the reasons to do so are, there's many reasons. But this comes back to this is where I appreciate the concerns. I mean, when you get a letter saying your mortgage is now owned by X, Y, and Z, but this goes back to the consumer protection framework, because what we're saying is that the framework is such that regardless of who owns the loans, the consumer protection framework that we have applies regardless. Now, that's not the only perspective on how these loans will proceed, but the consumer protection element is there no matter whether it's a bank or an investment fund who is owning the loan.
Yeah, but the reality is that, that I know that the consumer protection's there. I know that the legislation doesn't increase consumer protection in relation to the regulation of the owner, but that is not the core issue. The core issue is this: if I go and borrow €100 off you, Governor Lane, I know you're a nice guy, and if I find myself in trouble, you might give me a little couple of months to come up with it extra than our original terms. Whereas if I borrow off Deputy McGrath, not to pick on Deputy McGrath, Deputy McGrath is ruthless, and he will hike up the interest rates and all the rest, and that's obviously. I'm sure Deputy McGrath would give me the interest holiday as well. But that is the problem here. The problem is that these vultures have no interest in the main in terms of the type of restructuring that would be allowed, or that some of the main banks do, and that's the problem here. It's the short-term interest, whereas banks have a long-term interest. They want your deposits, they want your children's accounts, they want your student account, they want all of that, and that's why it's safer for individuals to have your we expect it to have your with an institution who is here for the long term.
So I mean, I appreciate that is a very widely held perspective. Now, this is not a complete perspective on it, but one perspective on it is what's been happening so far, and maybe if you want to talk about what we see in terms of the funds versus the banks.
Yes, so there is. I mean, there is an evidence. I mean, I appreciate that, and we've had discussions here before about letters received or phone calls made, and I appreciate the stress there, and that's why the CCMA is there and the Consumer Protection Code. But in terms of aggressively pursuing repossession as the kind of the ultimate last resort in terms of dealing with loans that are in distress, that there isn't evidence that they are pursuing that from a strategic perspective more aggressively than the banks, in terms of as a percentage of the loans that are in distress relative to how the banks are dealing with them. Where there is difference, and again we talked about that a little bit.
Is that just in looking at repossessions?
That's looking at
because the reason I ask you that, as opposed to them making arrangements that the banks would, because you have to put in the middle of that asset appreciation, where it makes sense for them to sit back while the assets increase. So
that's a reference to those that are currently classified as being pursued through the courts, effectively.
Yeah.
Now there is a difference, and as I said, we talked about this a little bit last time we were here, between the restructures that are in place in the banks and the restructures that are in place in the non-banks. And so typically in the non-banks there's less use of split mortgages as an example. Now, there is some more anecdotal evidence around maybe a greater willingness to do debt write-off through the non-banks than there is through the banks, but that's more anecdotal than hard evidence. So, but the fundamental is that the protections that are there in terms of the CCMA and the Consumer Protection Code, and Dover can talk a little bit to that, are there in place. Whoever owns.
I accept that in terms of, and you know, we've made that point continually to individuals, but there is the other issue. I know.
If you come back to the economics of this, as we were talking about earlier on, the fact that these funds have bought them at a discount, the fact they don't face the capital charges that banks do. So in other words, the running costs of holding these mortgages is less for the investment funds than for the banks. And that creates the room. This is why it's not obvious which way it's going to go, because I respect the point you make. On the other hand, because of the fact that they're kind of, these mortgages are lower cost for them, create some room for bargaining, more room for bargaining than, and this is why...
I agree with you, but your comment there, which is it's not obvious which way it's going to go, is the problem. You know what I mean? There's a huge risk there, and look, I've represented people who have a debt rate.
This goes back, I know, so this is why, if there was no reason to have these sales, then you could say, well, why, with that uncertainty, why do it? Because but this goes back to what I do say and what I do stand over, which is if you leave these on the books of the banks, and if we have a negative event, in terms of a severe downturn and so on, or there's a sharp change in funding costs or some change in the macro environment, that is a risk to everyone here. In terms of so there is a social reason. And globally, having this move from only banks owning mortgages to having some diversification of ownership, that is a global movement, and there is a reason for it. But you have to set that against these other factors, and this is why, and we do have this review of the CCMA, because what's happening is the banks or the investment funds are basically, they have restructures. Those restructures are agreements, they respect those agreements. The question is what might happen next, and maybe Derval can talk about the CCMA.
So, as you're aware, we're looking at, we're doing a review on the effectiveness of the CCMA, but particularly in the context of loans that have been sold. And we've done on-site inspections in the credit servicing firms. We're looking at their general compliance with the provisions of the CCMA. Excuse me. We're also, we've met a lot of stakeholders in the process to get their insights into what's working well, where they think the blockers are, their changes or improvements that need to be made. But a very important part of the work that we're doing is also analytical. We're gathering data on the loans that have been sold, the alternative arrangements, what's happening to those, in terms then of the range of options that the banks have as an array of options. What have they in place, the types of options that they have in place, and then out of those options, what in fact is actually being agreed with the customers. We're comparing that to the same scenario with the non-banks, which gets to the issue that's been discussed here, which is which way might this go? And of course, we're analysing that, and that's going to be reported on. So I think some of the data will assist us in having an evidence-based discussion around the outcomes that we may see occurring. But there is a backdrop to this that we'll have to factor into our thinking in that, which is some of the loans and people affected by them, the deeper arrears may be in the non-bank scenarios. So the range of options that they offer could be influenced obviously by the circumstances of the individuals that they're dealing with. So that work will give us some insights into precisely this point, and we've done a very deep exercise in gathering that in order to assist us. But coming back out of this for a moment, it's true though that the protections of the CCMA have helped lots of families and the approaches of the central bank restructure their loans. And it's really important actually that a broad message does go out to people that where they are in difficulties or might find themselves in difficulties, that in fact they do engage with their lender. Their lender is obliged to treat them sensitively with a view to seeking to resolve the arrears constructively where that's possible, and that is an outcome that is possible through the use of the CCMA and the engagement. So it's really important that people do engage with the process if they do find themselves in this awful circumstance.
Okay, thank you. Look, just two quick points, because I know my time's running over. Governor Lane, there was no reference to overheating in the economy or risk of overheating in the economy in terms of your presentation, and I know that any of the agencies externally or internally haven't said that the economy is overheating. They talked about a risk and that risk being medium and the effect being medium. We had from the Irish Fiscal Advisory Council quite a report which they provided a heat map. I'm sure you may have seen it. And their analysis was very clear that the largest risk for the overheating in the economy is in commercial property. Obviously, we know from the past, in terms of the property sector that led us into the crash, it was commercial property that was very much at the centre of that, at the heart of that crisis at the time. Do you share the same view of the Irish Financial Advisory Council, the Irish Fiscal Advisory Council, that it is commercial property that is overheating or at risk of overheating? And can I ask you, do you propose or have you suggested any measures that could limit that? We obviously had an increase in stamp duty in the last budget. It's still that sector is still booming, and I've raised my concerns in relation to a bubble emerging in relation to that sector. I know it's not being bank financed, but you're never going to have an exact mirror image of the crash, and that creates other risks.
So, I mean, I think when we think about overheating in general, this is an economy-wide type issue, and then you can maybe isolate more an imbalance in a particular sector. So when we think about the overall economy, we're not seeing it yet. I mean, unemployment is still in the 5s. There's still a way to go before you really get into the red zone, I think, in the labour market. So I don't think we should kind of be too early in kind of declaring that, because as long as it's still unemployment is still excessive, it's still above where it should be, we should not do that. But when you turn to an individual sector and assess what's going on in that sector, I think there's a few different issues there. One is what you're seeing when you see all the cranes around town is essentially the completion of a lot of buildings which were initiated several years ago when firms bought these at a bargain, it turns out to be a bargain price, and are completing the construction and are now trying to sell them. It's not my understanding that there's a new wave behind that. So in other words, one of the answers to the bubble is amplifying it by continuing to build even when the market gets closer towards completion. I don't think that's in the pipeline, and we do kind of gather information from the commercial brokers and so on about that. When you look at pricing, the pricing was very strong for a while, but in recent times it's kind of become a lot flatter. So it's not the case there's an onward acceleration in commercial real estate prices. What is true is, and the IMF has highlighted this, there's been an international synchronization. So in other words, there's a number of funds in the world which are active in a number of cities, including Dublin. And the question is, if those funds, first of all, if funding conditions change or they experience a shock somewhere, maybe this will lead to a synchronized reversal everywhere. So I can see that, but as you say, the kind of a lot of the financial risk is in those investment funds. It's not in the Irish banks. There are spillovers because the Irish banks rely on that pricing to price the collateral of what they do hold. Yeah. So I think it's a valid concern. We are going to release more work, by the way. So we've been working away, and a little bit prompted, by the way, that you wrote to me about one of these firms, that we have been working on understanding the role of investment funds, how they're funded, and I think we have some interesting work there that we'll be putting out. But it's definitely, there's an interesting delinking. This is the international message. Commercial real estate has been delinked from local circumstances. It's part of an international financial play, which may go into reverse at some point. So, you know, it's an interesting sector but, you know, I wouldn't call it a bubble here. There isn't a local element to the bubble. There may be that global element to it,
yeah.
but it's not the case. There's some mania going on in the Irish market.
Yeah, okay. And I welcome the work when it's been published, and obviously my concern was in relation to the level, the increase and the sharp increase in terms of prices in commercial property. And I know you said that they're not increasing at the same type of rate. But can I maybe ask you a separate point? Is in the issue of interest rates and mortgage interest rates, and while we acknowledge that a number of lenders have been decreasing over the last 12 to 18 months, at the level of interest rates, we're still double what the European average is. We expect that we will see ECB interest rates beginning to increase in 2019. It's likely to happen sooner rather than later. And we've never had the benefit of European average interest rates. Do you see a day when Ireland will be in line with the average interest rates? And if you do see such a day, when do you think it will actually happen? Because consumers are being ripped off here, absolutely ripped off, and they find it very hard to understand how, you know, we can talk about NPLs and the drag on banks and all the rest, but then to see AIB making €1 billion profit, Bank of Ireland making €1 billion profit and charging twice. They don't pay any tax in the state, and they charge twice the interest rates of European competitors.
So as you indicated, there has been some movement, which is encouraging. By the way, we think the policy world has helped a little bit with that by making switching easier, and the information campaigns and so on. So we are seeing some evidence that people are waking up, but we would encourage everyone. There's so many people who could still save money by moving, even within their own bank, to cheaper rates. You know, but the wider point is there, which is, as we indicated, there's no doubt there are some factors like non-performing loans, history of the crisis, and so on. But it is also a competitive issue. But there are no barriers to entry here. It is not the case that there's some block. We have a single banking union now. The good news there is there's no longer concern of different will the national regulator do something odd or surprising. They can rely on a European regulatory framework. So the answer is basically, I think as time goes by, the more we have a track record of the economy growing, the more we have a track record of credit not going crazy, the more we have a track record of mortgages being relatively low risk, low LTVs, reasonable LTIs and so on, the more the fundamentals will appeal. And by the way, internationally, there was a period when the banks were everyone was so busy fixing their own problems, the appetite for entering new markets was not there. But as if you look at what's going on, there's many discussions of cross-border banking, that we need to have consolidation, we need to allow the strong banks, the good banks, to expand. So I would be hopeful that there will be new entrants, or even the threat of it will force the incumbents to drive down their rates. So I think there is room in the margins for those to come down. But I think the only way to really deliver on that is not enacting new barriers to entry, not creating unstable conditions here, and then it does rely, because the reality is commercial banking heavily relies on private funding. Risk-taking people to fund these banks, and until they are confident they can make a return here, this may persist. So I think it's all in the right direction. More stability, lower risk credit environment, and so on will help to create conditions for new entrants. But I cannot tell you when that's going to happen.
Governor Lane, the final question I have for you is you're aware that there's a review in relation to bankers' pay that is ongoing at this point in time to look at whether the the cap of 500 million or 500,000 is appropriate going into the future, notwithstanding that Bank of Ireland obviously has always breached that threshold. Can I ask you whether the central bank has fed into that review? What is your opinions, if you can provide that to the committee? And this was probably instigated by the scheme that was going before the AIB board, which was looking at a bonus, and your views in relation to that. If you could maybe talk about your views, but also in terms of the culture of the banks and how remuneration can or can't affect that as well. Thank you.
Sure. Ed covered this a little bit earlier on, where basically one reality is there are firms here in Dublin and even more so in London who pay more than that. So it is the case there will be some individuals who decline to work for the banks with significant state ownership because of the pay. That is true. I think it's for the Oireachtas to decide the trade-off there. Do you want the market forces to work there to say, well, if the banks decide they think it's good value to hire someone at a higher wage, they should be let to do so? Or do you say, for public acceptability of a state-owned bank, we are prepared to live, and let's see what happens, maintain the cap, maybe you don't get every individual you want, but those jobs will be filled. And the question is, and I think I know this, I read there's now someone has been allocated a contract to evaluate that. So I do think you need to think about it in terms of the pro and the con of that, because it's a genuine trade-off there. Then in terms of anything about performance-related pay, I mean, I think we would always recognise performance-related pay that is aligned with socially desirable incentives. There's a good case for that, especially in a volatile industry like banking. Because what that means is when the economy slows down, their pay gets cut, and that provides a degree of stability. And you also need clawbacks, that any bonuses can be clawed back in the future over a long period of time, if needs be. But I don't know, Ed, if I missed something there.
No, I mean, I think that's pretty much it. I mean, certainly from a regulatory perspective, we touched on this a little earlier. The factors that the Governor refers to about clawback, about making sure that the incentivisation is consistent with kind of looking to the longer term. That's enshrined in the regs, but that's a different matter to the specific point in terms of the legislation here. What we would be very keen to see today is the cultures that are espoused by the banks, the cultural change that we want to see is properly incentivised, and that isn't necessarily always monetary. And again, we talked a little bit about this morning. Who's getting promoted? How are people being recognised for good performance? And that should be aligned with the cultural change that's required within these institutions. So, yeah.
Thank you. Thanks a million.
Can I just follow up on that question? Because you've given an answer which is kind of neither here nor there. And I prefer the answer that was given by the Central Bank to the committee when they visited there recently, the SSM, where it was said by Ms. Danielle Newey, is it, that it is not yet the right time to consider changing the current salary or bonus rules in place for Irish banks. Now, I think that's pretty clear. I think that's a message that I would certainly agree with. And I think that that's something that the Irish public would like to hear from the Central Bank. And it does go to show you that, you know, the manner in which the banks operate is, and indeed government, they say that, well, we'll have a look at that, we'll do a report. That's essentially what they're going to do. And the report will come up with the same reply that you have given, which is on one hand it's this and on the other hand it's something else. That's the reply, in my opinion. They have enough. And being profitable to the tune of €1 billion a year is just, while at the same time they strip people of their dignity even in dealing with them. It's just not acceptable. But can I come back to the non-performing loans bit again and the 5%? So here's what happens. The main bank gives a loan, and there may be a difficulty in terms of repayment, as there was with the banks in themselves. Then that loan is restructured and the customer lives with the restructured loan. And in spite of that, the bank sell that loan to a vulture fund. Now, the talk has been here about, you can do maybe a deal with a vulture fund because they bought it for less, you were saying it, Governor Lane. But the fact of the matter is that once you get to that point of being owned, having a loan owned by the vulture fund, your credit rating then on the ICB is affected. So you have no hope of getting a loan from anyone except the same vulture fund at maybe 10, 15, 18%. So you can never buy yourself out. That's the issue, particularly for business people who are finding themselves in this situation and attempting to rebuild. It's also the same situation for householders. Same thing. So the option of the credit union, which was there for generations, if you got into debt, you were able to get a loan from them. Now you can't even get a loan from them because you're on the ECB. That is the difficulty. And alongside that, then, you continue to say that the protection travels with the loan. And Mr. Sibley was telling us that, there's not a great deal of evidence of the opposite happening. And I keep on repeating myself here at the meeting to you that there is ample evidence out there of people being crucified by vulture funds as they attempt to rebuild either a portfolio or a home or a business or whatever it might be. And I've dealt directly with them, and I've repeated this to you again at previous meetings, and the experience has, for me anyway, has been hugely negative. And I pity the people that have to deal with the vulture funds. So, and I ask you to address this. A bank says that they are required by regulators to reduce the percentage of loans which are classified as non-performing loans. Now that's probably accurate. They're told to reduce them, right? So they're using their selection of words quite well. They're blaming the regulators. And in the second paragraph, when the home loaner or the loan owner would read this, for regulatory purposes, it generally describes a loan that is or has been in arrears as one that's in default or can be sold. But I would like the Central Bank to comment on what I've just said and what I've read out from that letter, and to tell me why the banks can't be instructed to drill down into their bad loan book and to bring around individual resolutions. Yes, there will be those that won't pay, so yes, they go and they sell them. But why can't you force the banks to do this, to make it an option for them to drill down and solve the loan crisis in the banks? Because they're flogging off the loans anyway at a massive discount. The profits are going out of the country because the vulture funds will take them. And the damage done to society, we've outlined it here before. So why can't you emphasise that other option to them?
I'll turn to Ed in a minute, but we've always emphasised, exactly as you said, there are choices here. It is not the case we instruct any bank to engage in loan sales. And to emphasise, we've also indicated there's been a lot of restructuring by banks. A lot of mortgages have been restructured by banks over the years. So it's not the case that they have not gone down that road, to some degree. But ultimately, the commercial decision about whether to do more direct restructuring, the commercial decision whether to put provisions aside so that something that would otherwise be non-performing can be on the road to performing, versus the decision to sell. These are not our decisions, these are the decisions of the banks, but Ed, making say more.
So, I mean, as you are, your kind of final point there, as you articulate it, is what genuinely has been happening over the history of the last eight or more years, is we've pushed the banks really hard from 2010 onwards to sustainably restructure loans to address the individual circumstances of borrowers. I appreciate behind every number that I'll talk about just momentarily, there are individuals there, and I do genuinely appreciate that. But just to give kind of a sense of it, so at their peak, kind of 1 in 8 owner-occupier mortgages were in default at the peak of non-performing loans in Ireland. That's down to about 1 in 16. That's still obviously too many, but that has been achieved through the splits, through the arrears caps, through the term extensions, through the forbearance. And so that there has been, at an individual level, individual circumstances, those borrowers understood and assessed and restructured on that basis. And it's required sacrifices on the behalf of the borrowers. It's also required engagement with the banks. Underneath that, there is, through the waterfall, there is protections in place, both through the private sector and public sector in terms of organisations that are there to try and assist borrowers in distress. There's the insolvency service at Ireland, and there's ultimately the court protections that are there. So, as you describe it, that has been happening, but we are now in a circumstance where, 5 years on from the peak in terms of the level of non-performing loans, we still have borrowers that are not just kind of 2 years past due, 5 years past due, kind of a big chunk of them. And that does require that if we are going to have the functioning market we talked about that serves the country, that does require that those are addressed. Whether those loans are with a bank or not with a bank, they are required to engage and consider the individual person's circumstances and try to address them. But one point of detail, you talked about portfolios. The protections of the CCMA are focused on those that are owner-occupier mortgage, so where the family home. That's where the focus of that is. If a borrower has invested in a portfolio of loans, that is a different matter, and the protections are somewhat different.
Well, I don't know, Governor Lane and Mr. Sibley, you answered that question. I don't know that you're clued in at all to it. I really don't. Now, just let me explain. I understand what the banks have been doing. So on a macro level, that they've got their big customers, they've worked through, going down to the very smallest of loans. So they're almost down to that level now, where they have a huge number of of loans that are in difficulty, right? They're not applying the same degree of effort in finding a solution for those loans as they did with the bigger loans up along the chain. And as a result, individuals find themselves in courts, they're lay litigants, they're defending against solicitors and barristers and the whole lot. And the banks up to now have pushed these loans to the courts. There's a huge number of them in the courts. And there's no effort being made by the banks once they do that. There's no effort being made by them to unravel and try and find a solution. And these are the clients that that come to me, that come to other members of the committee, I'm sure, fighting for their homes and trying to make some effort. And I don't know whether you know how difficult it is to get information from the banks. It's absolutely impossible. And I've seen that myself through individual examples. The last one, one that I can remember, was asking one of these vulture funds for information last Christmas. Still hasn't been given. And in the meantime, the client is just left there, wondering What about their business or their home or their loan or whatever it is they're trying to do? It is impossible to deal with them. And I know I'm repeating myself, because I said this before at different meetings, but it is the same story that I come up against all of the time. And you can see it in the language used in that letter from a bank to a customer. You know, you can't say it's a lie, but it's verging on it. You know, it's there. It's a play with words to make the customer feel that really we're not that bad as banks, but geez, those regulators, they have us under fierce pressure. We have to sell you on. That's basically what they're saying. And earlier on we dealt with the culture in the bank. That letter speaks loud and clear to a culture that doesn't give a damn who's regulating or what you're saying. That's a view that I have, and it's a view that I know is there all over the country. So can I come then to the ECB or the ICB? Now that I've gone through that loan sold on to a vulture fund, the client tries to buy it back, the central bank or the credit bureau has flagged the individual. So how is you're controlling the ICB now? Is that correct? Are they working within the bank?
No. So I mean, there's now this central credit register, which is well, maybe. So we have now fairly recently, but it's up and running, a new credit register. So all loans to individuals are going into that. So it's an alternative to the traditional credit bureau, which is owned by the banks. So it's a very important new source of information. It will allow banks to see the whole profile of an individual's debts, not just vis-a-vis one bank, but maybe other banks, and any history of difficulties there. So that is starting now. This is a new piece of information. I should say also, soon enough, there's going to be a second register called Anna Credit, which is a European-wide credit register for bigger businesses. So for bigger businesses, there will also be a similar database of debt. So this is intended to improve the information available to lenders to assess credit risk more accurately. So it does go back to...
Sorry, is the ICB then finished? And this is...
No, I mean, because of the fact the credit register... Well, first of all, it's a decision for those who own the ICB to decide whether it has a business future. For now, I mean, the central credit register is only in the kind of startup phase, so I don't think there's any decision yet about the future of the ICB. But the central credit register is an important new source of information. The Anna Credit register, when it's on stream, will be important. So the amount of information available to lenders will go up. Now, your basic point there about is someone in this situation totally stuck because some historical default or some non-payment means that there is a flag on their record. And I think, again, we have to make a distinction between households where the consumer protection framework is strongest, and then treatment of the small and medium enterprises and bigger firms, where it is the case that how a loan contract is managed is going to be different. The level of protection for consumers is naturally going to be a lot higher than for business enterprises because of the basic differences in those two types of loan and activity. I mean, that is true. So the experience, I'm sure it's very tough for many small businessmen. I have no doubt about that. And the question there is about how a bank or a non-bank should treat those loans. But maybe in terms of...
Can you address the issue of them not being able to get loans, those small business people, and the credit union being closed off to them as well? Is there not an argument for easing the regulation in this area for credit unions? Because they grew small businesses in their day because they knew the individuals, they knew the risk better than most. And now they're the only ones almost that are represented in terms of banking in the community.
So let me turn to Ed on that.
So, I mean, on the specific point around credit unions, and this has been reported, we are looking at the lending limits that are in place today, and making sure that they are fit for purpose, and we'll consult on that shortly.
So can credit unions do mortgages now?
Well, credit unions can do mortgages today.
Yeah.
And many
with total freedom, or what?
Many of them do. There are two limits in place in terms of lending over greater than 5 years, lending over greater than 10 years. Currently, in aggregate, and I appreciate there are a small number of credit unions that are already kind of close to these limits, they're lending about a third of what in aggregate they could lend relative to those limits, but there are a handful of credit unions that are bumping up against those limits. So they can lend from a mortgage perspective today, and many are, but we're looking at the approach to how those limits are calculated. So at the moment, it's based the limits are based on their total loan book. So and as you'd be well aware, number of loans in credit, or the amount of loans in credit unions, has been flat to falling. We think a better answer to that is to focus on the reserves that they have, and to put the limits in place around the reserves, so their capacity to lend. Well, we're going to be consulting on that very shortly.
Just the earlier question, and what did you say about their ability to lend to someone that they know went through a bad time and now is less risk?
So they have. So there are, in terms of what the credit register does, it gives information. It gives information that allows the lender to make a choice. That's
is it still the case that the lender, be it a credit union or not, makes the choice?
Yes, exactly.
And they're not penalised anyway, should the choice be to support the particular business or individual?
So as long as they've understand the facts on the ground, which will include looking at the credit register for loans, I think above €2,000, they can make a choice.
We've looked at the register and we've seen that, but we understand the difference in the current state of play, and on the basis of that, we're going to give the
exactly.
Okay, right, thanks. Sorry, Deputy McGrath wanted to ask.
Yeah, thanks for leaving me back in before Senator O'Donnell. I'm sure he doesn't mind. I just want to come back, Governor, on your exchange with Deputy Doherty on the mortgage interest rates issue, and we've had a number of discussions on it over a long period of time at this stage. And just a few observations to you. I think we don't hear enough from you or the Central Bank on that issue. You know, when you were pushed, you did indicate that you felt there was scope for further reductions in the margins, I think was the term you used. So, in effect, you know, you're signalling that you expect reductions would be of a very modest variety. But I have repeated the point a number of times as to what I would regard as anomalies that you're standing over. If you take Permanent TSB, a bank with significant challenges, nobody's questioning that. But again, they announced a cut in fixed rates for new customers. Their existing customers will not benefit from those rate cuts. I think that's completely unfair, and I think as the consumer protection watchdog, the Central Bank should be saying that that's not acceptable. You have nothing really to say about this whole cashback incentive. I would regard it as a gimmick that a number of banks continue to engage in, which are really used as a way to confuse customers, to dazzle them with a few €1,000 here and camouflaging higher rates. You don't want any powers to deal with high interest rates. So, as Deputy Doherty said, our rates are very high. In the last retail interest rate statistics, 3.21% was the average in July in Ireland. A new mortgage, 1.77 in the Eurozone. So we're the highest. The only other one above 3% is Greece. So we're well and truly the highest. And yet you don't want any powers, even if it's non-discretionary powers, even if it means putting in methodology into legislation or putting in a reference rate, and a number of countries have done that, as you well know. But even to have that stick there, a threat, you don't want it. And I know we have the issue of trackers in Ireland, and I don't mean the tracker examination, I mean the fact that a significant portion of the book is on a tracker rate, but they're not loss-making anymore either, let's be honest. Tracker mortgages are profitable for banks today. But I get the sense, when I look at Ulster Bank came out with a 2-year fixed rate back in, I think it was June, the end of June, 2.3%, albeit only 2 years. I thought that was a game changer. It was a significant cut below anybody else. I thought the others are going to have to respond, and yet 4 months on, there really hasn't been any response from the others. So they all strike me as being very comfortable with what they have. There's no real competitive dynamic in the market, apart from on the issue of cashbacks and these dazzling offers around lump sums and maybe paying legal fees and so on, but not on actual rates. And like, okay, you might regard your core priority as being prudential supervision, protecting the stability of the financial system, but you are, for now at least, the consumer watchdog as well. And I don't hear you dealing with those issues on interest rates.
So let me turn to Dermot in a minute about some of the ways consumer protection is very much involved in some of the issues you've raised. And I'll let Dermot speak to that in a minute. But coming back to the reality here is what we're seeing is some mix of risk premia and lack of competition. And if, you know, when you make reference to other countries which do have ceilings and caps, it's not the case, it's at the fine-tuning element of 100 basis points, 150 basis points. It's to rule out really high interest rates way above what we're seeing here. So it's not the case that we or anyone else, I think, can draw the line between saying this is what's reasonable on a risk premium basis and no more than that. And as you know, if you have a situation where a law, which by nature of laws they're hard to undo once you've got them, which pitches this at the wrong level, then you do have a serious barrier to entry. So that is the problem with trying to find a legislative solution to this. So the other approach which we've talked about, which is promote entry, keep barriers to entry low, keep the system stable to reduce risk premia, and then watch as entry or the threat of entry does its work. That is, if you like, the way, I suppose I would see it as going. But on some of the particular issues there about the switching, the front book, back book, the issue about cashback and so on, I mean, we do a lot of work on these issues, but maybe Dermot can elaborate.
So on the more narrow issues that you've raised, we've actually done a piece of work on any of the advertisements for discounts, initial discounts or cashback offers. There is a place for offers like that, but it's only important to know that they're appropriate for some customers, not all. And we've been very clear with lenders about that. And in terms then of getting the best value that people can for themselves, we've tried to be very public and clear that switching, there's an awful lot of benefit to lots of mortgage holders if they would shop around and get different mortgage products for themselves, that they could save themselves a lot of money over the lifetime of a mortgage. And because of that, already in the Consumer Protection Code, we require lenders to communicate to their customers regularly about what other offers they have for them that could save them money. And we see some evidence actually that switching is increasing at the moment. And because we know that even more work needs to be done to help people who already have mortgages get better value for themselves, we consulted earlier, I think last year and into this year, about strengthening the code into the future more so that people who come off a fixed mortgage will get 60 days, and I know that you made responses to that consultation in advance about what options they have when they come off a fixed rate, so they can make sure to look around and see what the best deal is. And if you have a variable rate mortgage now, lenders will have to communicate if you could get it at a cheaper rate if you would get a new loan to value statement. So we're putting a lot of pushes into the regulatory framework so that the information is being delivered to the customer's door to make sure that they have the information to help them look around to see if they can get a cheaper, better product. So there's some of the improvements that we think will help people, but there is some evidence that people are increasingly taking to switching.
Chair, is it the case the Central Bank would not support the removal of these cashback incentives as a means of trying to drive down rates, to remove that element from the offering, so that banks would then be required essentially to compete on rates?
I know that's the inference you draw from what would happen under a ban. But we've looked at this quite a bit, and we do think it's not the case that a ban is, because they do have a role. So the consumer protection issue is, do people fully understand, can they see through the dazzle? And in terms of, it's not just the case we looked at the ads, there was a lot of ads withdrawn. I mean,
no, we affected a lot of change as a result of that. What I'm saying is that it's about the right product being sold in the correct way to the right customer to meet their needs. So it's no good if cashback incentives in the bad old days pre-crisis were putting cars outside the front door, and that's not what it's about. But there may be an argument where it's for essential necessities, maybe a washing machine or some of the very basics, that people understand that. But what's very clear is the cost of that credit, and that it shouldn't be missold. So sometimes it's not about the product, it's about making sure that the product is properly sold to the benefit, that confers a benefit on the right customer, and that's just as important. And to eradicate that product may not necessarily result in cheaper mortgages across the board for all.
Okay, Senator O'Donnell.
Just a few quick questions. You can advise me, Chairman, whether they've been dealt with or not. I wanted to ask about Brexit, and you have hard Brexit, soft Brexit, or no deal at all. Have you quantified the impact of each of those in terms of the impact it would have on GDP?
That was generally dealt with.
Do we ask for specific?
Unless you want.
Did you deal with specific? I'm looking for what the actual numerical impact on growth, on GDP, on employment, on consumer spending under those three scenarios. Have you done such?
Yeah, so we will be publishing our next quarterly bulletin, which is nearly being finalised in terms of preparation, has material on that. So we've run, I mean, there's obviously a lot of people running the models for that, but when I was responding to Deputy Doherty a little bit ago on this, it delivers an answer. It's negative, that Ireland is not just affected if the UK goes into recession, but any of these scenarios, severe scenarios, will lead to significant sterling depreciation, which will hit Irish exporters. But what I'm emphasising is that the models typically will understate, because on top of those kind of model issues, you can have the turmoil. The financial markets will be rocky. You'll see possibly movements in stock markets, in exchange rates, and so on. So I would not take excessive comfort from any quantitative numbers that we may put out in the next couple of weeks on that, because on top of that you have this kind of financial sector turmoil which could have its own dynamics. So I would say, that it's not the case, no matter how hard the Brexit is, it remains the case that rich countries have different trading arrangements, that it is negative. It would lead to lower living standards both here and in the UK, but it's not the case that suddenly the UK falls off the map, it suddenly becomes a zero trading part or whatever. It's a regrettable negative, but we shouldn't be, we should contained in the event.
So in all scenarios, whether hard, soft or no deal, it's a negative for Ireland?
Absolutely.
Okay. Can I go on then to we were, once again, it may have been dealt with, the whole area, we met the ECB and the whole area around sustainable mortgages and the definition of a sustainable mortgage. And we found the ECB took severe umbrage in Frankfurt that they were being blamed by all and sundry for the need to sell non-performing loans to funds and to deleverage at a rapid rate. In fact, they took it quite personally and were quite forthright in saying that, as far as they were concerned, they gave us, for the first time ever, what I would regard as a common sense definitive version of what a sustainable loan is. They said a sustainable loan is a loan that the customer can afford. The rest of it should be warehoused. So you have your senior, which is what the customer can afford, and that they can afford to repay it like any normal mortgage. So if you had someone that had a mortgage of, let's say, 200,000, they technically could afford 150 of that. As far as they were concerned, the sustainable of that was within their own age profile. So if it could be restructured as a 20-year mortgage, that they could repay the amount in 150. The balance of that should be warehoused. They did not regard that as a non-performing loan. And I just would like to know your perspective on that, because it was a very, very, very... we had a lengthy enough discussion on it, and they were quite forthright on it. So it was the first time I got a definition of both what's a sustainable loan, which at the same time meets the criteria to be not regarded and to be deemed as a non-performing loan.
So we touched on this a little earlier, but I'll address it again. So I think two main points or two main questions you have there, which is around the pressure from the regulator to drive down non-performing loans, which is undoubtedly there. What has never come from us or the ECB is a specific target or indeed a specific methodology or approach to, in other words, to drive banks to sell loans. That's never been the case. We've never instructed, ECB has never instructed, but there is significant pressure, and for the reasons we talked about earlier, there will remain pressure on banks to bring down.
The banks are putting it out in the ether in a big way.
No, I understand that, and I have lots of conversations with the chairs and the CEOs and other board members and other members of the bank about this very issue, because I'm very clear about it. There is not a target. So that's the first point, and we expect the loans to be addressed through various mechanisms, including restructures, which is the second point you touch on. We've been very clear, I think, throughout what we've described as sustainable. We put out sustainability guidelines in 2013 when we issued targets in terms of mortgage arrears reduction, and that really drove change in terms of the bank's approach to dealing with mortgage arrears at that point, which had been very much kind of short-term forbearance rather than dealing with the underlying issues, and that has resulted in a very high number of restructures being used to address the issue. There is a specific point in there around split mortgages, which I think was the germination of the discussion you had in Frankfurt.
Yeah, split mortgages, yeah.
Yeah. So, and we've been clear with all the banks, and we engaged with our ECB colleagues just to add further clarity, because this product or a variant of it is used in other Eurozone countries, that these loans can cure. So these loans can be treated as performing forborne, so become no longer non-performing. What it requires here or in any other jurisdiction would be that warehoused element was fully provisioned. So in the example you use, you take a provision of €50,000 for that loan, and if the bank does that, and subject to the borrower repaying to the new term of 150 you use in your example, over a period of probation, say about a year, that loan could absolutely return to a performing status and no longer be non-performing.
The final thing then that we discussed was around the Anglo promissory note. I don't know if we touched on it, and the question that came up is the ECB in Frankfurt putting the Irish Central Bank under increasing pressure to effectively unravel the Anglo promissory notes quicker than was the schedule that was established at the time the restructuring took place?
Okay. So back in 2013, when this was set up, there was a minimum schedule. And that's very important, that minimum schedule was very minimum. You know, small numbers, far less than we're actually doing. And the way to think about that is, if the world had turned out worse than has actually happened, if the recovery here had been weaker, if the interest rate environment in Europe was higher, that the scale of the disposals could have been done at a super slow pace, which is the minimum schedule. The fact that the world has not turned out like that, the fact that the interest rate environment is quite low in Europe, the fact that the Irish economy is growing quickly, the fact that the fiscal position of Ireland has improved, does mean that the second part of that agreement was we would sell as soon as possible, subject to financial stability considerations. So the fact that was a minimum schedule, and the expectation is, but this is something that was always agreed to, that we would sell more quickly, subject to maintaining financial stability. And that is why we're selling at the pace we're selling. But there is no, that minimum remains. So if there were a severe change in circumstance, the minimum becomes more relevant. But under current conditions where the NTMA can borrow quite cheaply, this is why we are selling at a pace. But
and where is it at the moment? Of the, I think the original figure was it about 27 billion?
Right. I don't have right in front of me the number, but basically we sold 4 billion last year. We've sold, I think, 3 billion in the first 3 quarters of this year. So we're down around 11 or 12 at the moment, but we can get you the exact number. So
that means that you've sold, at this stage of the 27, you've sold 16 billion of them, correct?
In that neighbourhood, yeah.
That's over, what, a 3-year period?
Maybe a bit longer than that, but yeah, 3 or 4 years, yeah.
And when do you anticipate that will be, like, the impression was that at the time that it could be spread over up to 40 years.
These are very long-term bonds, that's true.
Okay, we're suddenly finding that's now coming back within 3 years. The ECB said to us that as Ireland refinanced its debt in terms of the IMF programme, or any of the other bailout programmes, that they would then be putting pressure on the Irish Central Bank to effectively, for want of a term, tear up the promissory notes, right? They regard it as quantitative easing. For us, the ordinary taxpayer is still left with the 30 billion.
But it's very important to say, the way to think about this is there's a risk of not doing, so regardless of our commitment as a central bank to sell these down at a reasonable speed, subject to financial stability, if you take it from the fiscal point of view, the question is, when we sell these to the NTMA, currently they can refinance it at super low interest rates. The NTMA are selling debt at a very low interest rate. Imagine a scenario where we had some of this had been delayed, I don't know, for 5 years. In 5 years' time, when that transaction might have happened, the refinancing cost could be more expensive than now. So the kind of pro and con on the other side of this transaction.
But it is fair to say, Mr. Lane, Governor, that the current construct that was set up, that's still costing less than, would have cost less than where you're actually effectively refinancing into third-party government debt.
It depends. It depends. It all depends on that calculation. Depends on the future of interest rates. If it turns out the future interest rates go up in the future, that may not be true.
So you give me the reason. Can you make any financial reason as to why the Irish Central Bank should speed up the sale of the promissory notes?
With any type of
disposal of the promissory notes.
With any type of emergency funding, any emergency funding from the central bank is intrinsically temporary in nature. Now, this is has been a very drawn-out process. So the normal temporary nature, as you indicated already, a different type of temporary funding is from the IMF, which we paid off. So the commitment was always that this would be temporary in nature.
Yeah, but I suppose the question is, we're suddenly gone from potentially up to 40 years, where based on the projection here, this could be refinanced and into third-party government debt within 5 years in total.
And again, in a situation where government debt can be issued very cheaply at the moment, the long-term pro and con of that from a fiscal point of view, which is not part of the way the central bank can think about it, given the separation between fiscal and monetary, that is an open question. But absolutely, I think the minimum schedule at that time was very important insurance against, at early 2013, it was not obvious how the Irish economy would recover. So the fact that at that point there was the assurance given that there was no inevitable acceleration, there's no inevitable rapid disposal, was very important in terms of providing a fail-safe for the situation. The fact that it turns out the recovery has been better, financial conditions are easier, has, if you like, allowed a more normal speed of disposal to take place. And that's what we're doing. We still bear in mind that we don't want to overburden the sovereign debt market, so it's not instantaneous. And if you like, that's a path we're treading, is we do want to respect the temporary nature of this funding, but we don't want to go too quickly if that overburdened the sovereign debt market and caused financial instability. But I do think from the Oireachtas point of view, from the fiscal point of view, it's very important to recognise that this was always going to be refunded or refinanced at some point. And the question is, given the low interest rates available now, maybe that would not be true into the future.
Okay, just one final question. The whole issue, we also, you probably are aware, we did a visit to Germany and Sparkassen, public banking. It's not around the Sparkassen I want to ask the question, it's around public banking. And the whole issue of, do you believe there is a need for, I suppose, an expanded public banking model in Ireland in terms of being an additional pillar to the mainstream banks? Two, Unpost and the credit unions have recently come out stating that they're looking to provide, and our chairman made reference to it earlier, provide mortgages, low interest rate mortgages. Unpost very much on the Sparkassen model, low rate. The credit unions are speaking about a competitive rate. So the question is, can you see a fit here for a public banking model involving both institutions, whereby, particularly within the credit union movement, who have such a phenomenal network as Unpost do, that you would be able to bring in further regulation to allow them to lend to the SME sector in a structured way, outlawing any form of speculative lending. There would be limits set on the level of SME lending they could make, and in terms of the home loan market as well, that they may have to look at bringing about, we'll say, a central bureau in terms of assessment of loans, in terms of SMEs. I feel very strongly, I'm on the record of saying this many times, if the credit union movement were not there in the 90s, many of the SMEs would have gone under. The mainstream banks were not giving credit. Many of my clients, I was in practice, smaller clients, were going down to the local credit union on Monday morning, getting a bank draft, putting it into their overdraft facility with the mainstream bank 100 yards up the road, and they were providing the overdraft facility. I have a great affection for the credit union movement. Mr. Sibley would know that, but I am also pragmatic, and I want to see if there are areas that could be improved, because I believe my biggest weakness is that when the banks fully recover, we'll have lack of competition in the market, real competition, structured competition. So you might just give me your perspective on that. Obviously, Mr. Sibley, yeah, thank you.
Yes, there's quite a lot in that. So if I don't cover if I don't cover everything, please let me know. So in terms of a public bank model or some kind of combination of the credit unions coming together and working more as one as opposed to individuals.
Still maintaining their individual identity.
Yeah, so some kind of shared services model. We're entirely open-minded about that. I would have I can absolutely see that there would be some benefits there, because one of the issues that the credit unions have is on an individual basis, the scale that they have and the costs of undertaking mortgage lending and really lending with any kind of scale to SMEs. So having a degree of shared services, whether that's in the form of a public bank or some kind of third party that allows them to do that, I'd have a lot of sympathy for it. As I've said here before,
it's a public banking rather than a state bank I'm talking.
Yeah,
we'll have a forum.
Oh, yeah, sorry.
Very shortly.
Yeah, okay.
So maybe the central bank will have an input into that also.
And perfectly happy to engage on it. We do a lot of work with the credit unions in terms of supporting them in terms of business model development, the engagement we have, and other forums. In relation to the lending that they're actually doing today, as I discussed with the chair a little earlier, we are looking at that, and we're expecting to consult on it. The approach to how the limits work today, where it's a factor of the rest of the loan book, I think it would be better if it was focused on reserves, because that actually gets to the capability and capacity to lend. So we'll consult on that, and we'd certainly welcome views from all stakeholders in terms of how that looks into the future. And in relation to the Sparkasse, and I know that wasn't your direct question, I mean, we've engaged with them a couple of times. There is no restriction on them coming here. I mean, the issue that they've raised is actually how do they fund themselves? How have they got enough capital to come here? Which is I mean, if they can do that, then that's absolutely fine. But it's not a matter for the central bank to provide that to them.
Thank you.
Can I just clarify? I was asking you about the ICB, and just for clarification purposes again, when banks are asked about loans, they only have to have regard for the ICB. There's no set down regulation within the banks that you can't get a loan because you're on the ICB. That's the first question. The second part of the question is, how long does that last for then? If you're on the ICB and the banks say, no, we're not touching you. I'm told it's 2 to 3 years. Is that right?
So certainly, as you articulate it, in terms of the credit register, that they have to consult with it for loans over 2,000, but there isn't a hard rule coming out of it. So they have the decision making remains with the lender, and it's not just for banks; it's for all lending. And
what about the period then?
I think I'd have to come back to you.
I've heard this talked about.
I mean, certainly there is a period where a kind of negative credit history would be on the record, and then at some point it'll be cleared. But can we come back to you on that
aspect of it? But I'm saying is that it's on the record and will be there until it's cleared by banks.
No, sorry, I meant that.
But it's not a case that even though it might be clear at 3 years on from that, you're still not a credit. Or you're still a credit risk. There's a regulation there. What's there about that?
No, so, I mean, in fact, we can come back to with some of those details, but the fundamental issue is it's up to the lender, and especially given the crisis we had, many people went into arrears because of bad luck.
Yeah.
It was not a signal about their future potential as a business or as an individual. So it is the case that banks can maintain an open mind. There's nothing to stop them looking into. Now, they may decide in a certain circumstance they're not going to make the effort beyond looking at the credit bureau. But as a regulator, you know, if there could be good business opportunities in lending to people who have had some record of distress, and recognising, looking to the future, they may be good risks. So that is essentially a commercial opportunity for banks who decide they can take that on.
Yeah, because you, in answer to Deputy McGrath earlier on, you were saying that the fact that there's higher interest rates doesn't mean that a bank, coming in, maybe an outside bank coming in, that they would look at the future potential, what prevails now in the marketplace and for the future. So I would think that the same should apply to business people who went through difficulty, or individuals went through difficulty. that they shouldn't always have to pay for that in terms of being listed as a credit risk for 3 years, even after they're out of the clutches of the banks. That's my point. And if we could have a note on it, maybe, relative to the earlier question about credit unions and how they operate vis-à-vis the ICB and your views on that. The other issue is the new regulation that came in regarding communities collecting money for and become a club or a piggy bank, and then they lodge it in the one name to the credit unions. And a regulation came in that began to regulate that element of savings, and it's having an awful effect on a lot of effect anyway, a negative effect on people who would want to save, who actually need the credit union and need to be able to save small sums of money every week, and it was working perfectly for them, and now they can't do it.
Okay, I don't know if you've had sight of that.
If you'd have a note on the reasoning behind that, a note will do. All right. Okay. And finally, then, just two things. GRG. Do I understand that you're conducting an inquiry into that whole issue?
So let me turn to Ed. Or Dermot.
I'm asking the question because today we received substantial information for the committee. I don't know how, the type of it. We haven't gone through it yet. And my query is the central bank conducting?
We certainly have oversight and are in regulatory engagement with Ulster Bank on issues that have arisen in respect of GRG, and you'll know the history of that.
But you don't term it as an investigation, do you?
Well, we're in there is an issue has arisen with Ulster Bank, with GRG. The origins of the matter is subject to a public report in the United Kingdom, where there was an allegation of deliberately distressing businesses and levelling complex fees. There was an investigation into that, and that the serious allegation was not found to be the case. But because of concerns about levelling complex fees on businesses that were going through difficult times for business people, a process in the UK was opened to deal with that. The identical process was put in place here, and we've been in regulatory engagement to make sure that that process is delivering in accordance with what it should do. And we have been over to the UK to talk to our regulators about the common issues arising in that, and we have been on site in Ulster Bank dealing with that, and we have had external oversight of that put in place, and you'll know that there's also an external complaints process on top of the normal complaints channels as well, and we required Ulster Bank to write to the affected customers and deal with that through the process. That process is open, available to customers and ongoing, so we are in regulatory engagement on that matter.
Just to say to you that those very customers have formed the RBS Ulster Bank GRG Irish Business Action Group, and today they've left in a file of papers to the committee, and I understand they have also left them to the fraud squad and to Ulster Bank, and perhaps others outside of the jurisdiction. So they're certainly ramping up their attempt to get justice as they would see it, and I'm alerting you to that fact, and we'll probably be forwarding the correspondence to you, in order to get some action on it.
So thank you. I can say that papers were delivered to the central bank yesterday, and of course in this case, like in all cases, we take account of all information and scrutinise that to see if it yields evidence with respect to breaches or issues regarding the regulatory framework, and where that is the case, of course, we follow through on that.
Thanks. And finally, can you give me a ladybird note on the Ballyhay Says No campaign? We sent you a transcript, at least I think it was the same transcript, on the 18th of July 2018. We had a meeting, a submission was made to the committee from that group, Ballyhay Says No, and they outlined specific issues to do with their campaign and their understanding of the promissory note bonds and the destruction of those. So can you review your letter of reply dated the 3rd of August to the committee here, in which you gave information, and just break it down for us a little bit more relative to what was said at that meeting that day, if you don't mind.
Sure. So, I mean, I think the fundamental issue here is any central bank, including the ECB and ourselves, would have the commitment that any lending provided in the middle of an emergency, such as the lending that was against those promissory notes, is temporary in nature, and that when the recovery kicks in, those loans do have to be unwound. So my reading of Paddy Hayes says no is essentially they would dispute that. They would say the circumstances are so specific and special in relation to this scenario that an exception should be made to this central bank philosophy that these loans do need to be unwound. That's, I think, fundamentally it. I can understand that point of view, but it runs against the foundations of how the central bank works, and it especially runs against the foundations of a 19-country monetary union. Because, if you like, other countries may make... You can imagine a situation where other countries said, well, you know, we have specific problems here, we have specific reasons why we need a special central bank funding as well. So it's one of the foundations of the euro is there is not, if you like, monetary financing of governments. And when you do have emergency loans, as was made to Anglo-Irish with those promissory notes as collateral, that eventually those loans are reversed. And that's what's happening is this is now reversing at a pace, but it's not a very quick pace. It's still a very gradual reversal process.
Would you give us a note on it?
I know, so I mean, I struggle because it's...
you're being more detailed now in your response.
Yeah.
I really want to understand their argument versus yours. And the note that you've given us is technical and so on in nature. But
yeah. But I mean, that's reasonable. I mean, it's an ongoing, and I very much respect the people involved there in their commitment. And let's see if we can do a better job on that.
Yeah, just to have a look at it. I'm sorry, Senator Horkan wants to ask a question.
Sure.
We're finished then.
Just very briefly, because I'm sure most of the points, I'm sorry, I'd arranged a couple of other meetings and we had a vote in the Shannon, so just... I did prioritise this from almost all of the day, Chairman, and I was here for a lot of it, as you know. And like yourself, there's only 2 of us left, but I'm still here. Just to, and I apologise if anything was covered already, I can look back at the transcript. There was a report last week about the categorisation of NPLs in terms of when something tips over, all of a sudden the whole thing, as opposed to a small percentage of it. Charlie Weston did an article. I don't know if anyone else raised it or discussed it.
No, I'm aware. So this has nothing to do with how any individual is being treated by any bank or any investment fund. It's purely a data gathering exercise. So we have in our central bank, we have a statistics function which gathers information from all of these entities. And this was simply just a case of some of the investment funds having their own calculations which are at odds with how the banks, which are under regulation, decide these things. So it does not change the picture for anyone in terms of how they're treated. There is
that macro picture, sorry to cut across, but that macro picture where we say PTSB or whoever's on 28% when they should be on 4 to 5.
Yeah, this is totally unaffected by this. Yeah.
Okay, so it's purely how some individual companies
some of the investment
separately
funds,
from
they're not under the same regulation as the banks. But we do think we need to get to a kind of a more comparable picture of how to report these numbers.
Just, I was on the Sparkcastle trip as well, and we were talking about credit unions. Is it correct to say that a lot of the credit union deposits were actually with Anglo back at the time of the guarantee slash, I suppose, the guarantee really, and if the guarantee hadn't happened, do we have any figures on how much percentage of credit union deposits were with Anglo? Because certainly at the time I remember hearing that there was a very substantial portion. If Anglo had gone, which lots of people might have liked it to go, a lot of credit unions would have possibly gone with it.
Let's see what we can provide for you, but it's very important to actually make a distinction regardless of what they may have had on deposit with them. In addition, there's also the issue of credit unions investing in bonds issued by banks. Because, as you know, under the new system now, the presumption is different types of bondholders would lose money if a bank has to be shut down. And so there's a two-parter there. One is the narrow issue of bond funding and how much the credit unions were exposed through their bond holdings. And then the larger one is, imagine if large depositors, as happened in Cyprus, had also received a haircut. So let's see if we can provide you with any information on that.
I'd appreciate that.
Certainly was the case that they had deposits and indeed some bonds with Anglo, and they have and remain pretty highly concentrated in terms of their deposits in the Irish banks. The change we made to the investment regulations recently enables and indeed seeks to encourage a bit more diversification in terms of where they're investing their.
I mean, certainly we looked at the behaviour of credit unions, and while some of them had mistakes and some of them got things wrong, it was a fraction of the level of damage that was done by the banks. But I think it is important that people realise that credit unions were relatively okay. If the bank guarantee hadn't been put in place, they would have had a much bigger problem than they ultimately had. And then just, have you any thoughts on, don't think your statement covered things like our exposure in terms of our significant dependence on a very small number of companies for such a large percentage of corporation tax and CCCTB, digital taxation, all the European ideas that may jeopardise some of that money?
Right. I mean, I'm not sure. I didn't particularly dwell on it here. I think I had a line about international tax. But clearly, I mean, my pre-budget letter, I mean, it's obvious to everyone. It's hard to assess the future of that corporation tax. So, assuming, we think it's wiser to assume that some of that may not be there forever. And so maybe you would want to either save it for a rainy day, or at the very least, because we will now have this build-up of public investment. In terms of framing the debate about the public finances, I think making this distinction between uncertain revenues versus what you can rely on. And it's very important here, because before we doubled down. We had the construction-driven economy and we had the reliance on construction-related tax revenue. With these global corporations, it's de-linked. So the Irish economy is working away, growing, and the profits from these global corporations more or less depend on their global activity. So that could kind of reverse even if the Irish economy is doing okay. So it's a different type of risk, but definitely it's a big issue for everyone to think about in terms of risk management. How much of that is potentially at risk? How much of that can you rely on? And given we don't really know, in a world of uncertainty, how do you balance those risks? That's for sure. It's kind of a screamingly obvious challenge for us all.
Okay, thank you very much.
Thank you very much, Governor Lane and your colleagues. Thanks for attending. The meeting is now adjourned until Thursday, 11th of October.